40 minutes, but if you could do it less than 40 minutes, it's fine, so that you allow members more time to interact with your presentations. And then after the PBO, will then be having a briefing by the Financial and Fiscal Commission. Again, there'll be for 40 minutes. If it can be done in a lesser time, it's okay. And then there'll be discussions, and that will take care of the presentations. Then we'll deal with the consideration of recommendations by the subcommittee on the appointment of a PBO director, and then we'll close. PBO, and I'll definitely be timing you. Who's leading the team? Discussions, and that will take care of the Parliamentary Budget Office. Then we'll deal with the consideration of recommendations by the subcommittee.
Good morning, Chairperson. Can you hear me?
Yes, we can hear you.
Oh, thank you so much. Thank you so much.
PBO, and you are muted. You are muted. You are muted. The team.
Okay, so should we start, Chairperson?
Yes, Dr. Janchis, your stopwatch is already moving.
Thank you so much. No, I was waiting for colleagues to add me as a co-host so that I can load the slides. Chairperson, can you hear me?
Sorry, Chairperson.
Hi.
Oh, thank you so much.
Sorry, Chair. This thing is televised live at the moment, so I think we need to be mindful of that.
You are muted. You are muted. Thank you so much. Honourable members, if you don't have the challenge of connectivity, we always prefer that your videos should be on. So if you don't have a challenge of connectivity, please just keep your video
Sorry,
on.
Chairperson.
And then Dr. Janchis, introduce your team, and then let's go.
Thank you so much, Chairperson, for the opportunity. If you I'm with my colleagues. I think they'll introduce themselves when they start presenting. I'm struggling with moving the slides. I'm struggling. The slides can't move.
Hi, Dr. D.
I'm struggling to move the slide. No, thank you so much, Chairperson, for the opportunity. Yeah, it's fine.
Okay, yeah, it's fine. It's moving now.
Yeah, thank you so much. Thank you. Thank you so much, Chairperson. Sorry, honourable members. Good morning, honourable members. I'm struggling. The slides can't move.
Hi, Dr. D.
I'm struggling to move the slide. New presentation. Presentation outline. Just quick update. I think just want to update the members that some of the updates from the slides that we sent yesterday, and they will just reflect those, or we'll still share with these members the updated slides later during the day. Just a quick introduction. The MTBPS proposes and set out government strategic priorities and budget allocations for over the medium term, and the policy further policy affecting public finance.
What's happening? Your connectivity is really straining us. We can hardly hear you. What's happening? I think you are allowed then to switch off your video so that we can hear you.
And the policy. Thank you. I was saying the policy statement further set out economic context affecting public finances going to the budget proposals in February, and of course the money bills. What we did this time around, also Chairperson and all members, we set out some of the money bills requirements in terms of what needs to be considered by Parliament when adopting the revised fiscal framework. So we placed those there just also to remind ourselves, but also to remind members that some of the matters or issues need to take into account when considering the revised fiscal framework as it's been revised in the medium-term budget statement. And of course, globally, the COVID-19 pandemic infections continues to grow, members, and also here at home, we've seen cases also growing, with many countries experiencing second wave of the infections, and as a result, many of the countries have decided to lock down their economies to try and reduce the second wave risk of widespreading the virus in that regard. The second wave certainly creates huge uncertainties about implications for global economic recoveries. In particular, uncertainty about when an economic recovery will begin. There's a global consensus that public sector actions in the form of fiscal and monetary stimulus remains vital to avert further collapse in economies and so on. So it's very important to realize the role of the governments globally and also in South Africa. Therefore, the 2020 MTBPS proposes steps to reduce fiscal deficits and stabilize debt to GDP ratio over the next 5 years by rebuilding the economy.
Please mute, honorable members. Mute. You are eating on Dr. Janchi's time.
Thank you, Chairperson. They're eating my lunch. And by rebuilding the economy through the implementation of the economic recovery plan, but also improving efficiency and composition of spending. However, it is important to realize that the 2020 MTBPS proposals are affected and dependent on uncertainties, as you realize that, let alone the potential economic effect of the continued growth of COVID-19 and so on, and implications on economies, but also the fact that there are further negotiations that still need to take place between the government and various sectors, and also in particular the wage bill discussions, but also the outcomes of some of the performance reviews, reviews of constitutional grants, provincial and local government spheres thereof. So therefore, what this means is that taking into account of these variables and these factors, there are probabilities of further fiscal slippages over the medium term. Chairperson, I'll give Dr. Siraj Mohammed to take us through the macroeconomic environment. Thank you. Siraj?
Honorable Chair, thank you, Dumasani. I'm going to take us through the macroeconomic overview and fiscal policy section. But with regard to the deliberations on the fiscal policy framework, the situation with regard to increasing deficits and debt raised serious concerns. The key question that comes up as we continue to live with the pandemic and with the crisis before the crisis that is exacerbated by the pandemic, a key question that comes up is how the state responds to the crisis and how to think about government spending and debt with regard to the role of the state. And I think it's worth noting that the role of the state has been an important discussion, even with free market magazines like The Economist, the Financial Times. There's a pointing towards the state playing a larger role in the economy, not only to deal with the COVID-19 pandemic, but also with the recovery. We've seen increasing shifts in using things like quantitative easing, increasing agreement with debt, increasing amounts of where central banks are buying government debt. So we're seeing a lot of what were previously seen as the way to run the economy and the way to think about the fiscal framework coming under a serious discussion and changes. And so at this time, it's important to look at the MTBPS and to see the target of reducing debt and rapid debt reduction as possibly mixing up a target with an instrument. You know, the target should be the socioeconomic conditions in the country, and the way to get there and the tools to get there is partly government's budget and how government spends. So we are concerned that government may be too focused on rapid debt reduction at a time when the pandemic is not over and could well deepen, and may ask whether spending cuts in critical development areas could reverse socioeconomic gains. Will these cuts also affect the country's ability to respond to current and future health, environmental, and other crises? And we see looming on the horizon these kinds of crises, not possibly, potentially not too far away. And during times of crisis, uncertainties are high and aggregate demand is weak. And the private sector is generally unable to drive recovery, and we see that they prefer to keep their assets liquid rather than sink it in fixed investments. In economics, we talk about irreversible investments, and we talk about liquid investments, and a lot of real sector investments in building factories, buying machinery, those things are irreversible. You in it for the longer term. And during this kind of crisis and uncertainty, the private sector prefers to keep its assets liquid. Expenditure cuts means government is reducing the state's role in the economy at a time when it's critical for the state to step up. And as I just said, where the private sector may not be interested in making long-term, or not necessarily interested, but the uncertainty will act against them making long-term commitments. The current state of the South African health system teaches us that plans to leverage private sector investments in critical areas of service infrastructure provision, where social rather than profit motives should drive economic activity, could increase hardship and inequality. Next slide, please. This slide shows the different parts, expenditure components of GDP. And we see, as we pointed out quite a bit, that household consumption is a big part of GDP. It makes up close to 60% or around 60% over a fairly long period of time. What we see is also that in real terms, this is 2010 rands, we actually haven't seen large increases in government consumption. This is government expenditure, and government consumption in this case can include what we may see as investments in society, in health, education, providing basic services, and in the COVID things like provision of water, sanitation, etc. So I think we need to broaden our thinking about consumption spending and the relationship between capital expenditure by government and consumption expenditure. Gross fixed capital formation, I'm sorry, I'm still on the slide, which includes the private and public investment, has also been fairly flat during this period. And so we see over the period in the graph that aggregate demand was very low in the economy, even before the pandemic. Next slide, please. Just to come back to household income and debt, we see that aggregate demand will be under even more pressure, severe pressure, as household consumption declines due to loss of income, which the first graph shows, and with loss of income, we see consumption of households collapsing. And then the second graph shows how household debt to disposable income has increased. And what's happened is that the households have actually decreased debt this year, but because of the loss of income, the debt to disposable income ratio has increased to 85.3%, the level that we saw last in the global financial crisis. Next slide, please. And I think it's also necessary to be clear that the decline in real total investment from 2016 to 2019 was due to decline in public corporate investment, investment by public corporations. We see that the decline in total investment from 2015 to 2019 was 31 billion, and the decline in investment by public corporations from 2015 to 2019 was around 32 billion, which is 1 billion more. And the private enterprise investment grew in real terms by about 1 billion during this period. Next slide, please. So we're showing here issues of credit extension, because the issue of credit in the market and the fact that if government increases its borrowing, they're going to crowd out private sector ability to get debt and not invest. But we see, if you look at, this is credit extension by all monetary institutions as a percentage of GDP. If we look at the last 10 years, or even back to 2000, the major parts of this have been loans and advances, and within that, a growth since the global financial crisis of unsecured debt, credit card debt, etc., which is in the orange area. In the gray area is mortgage debt, which we see decreased after the financial crisis. And the reason why households have struggled is because of higher interest for unsecured debt. But if you look at the top of the graph, the green part is net credit extended to private sector, and the blue part is investment. And we see a relatively short small, portion of credit extension going towards investment. Next slide, please. So what is happening is that if we look at this graph showing credit extension to the private sector, private businesses as a percentage of GDP, and also investment by private businesses, we see that private business enterprise investment dropped by 0.7%, but that the credit increased from, say, I'm talking about 2013 to 2019, to the credit extended to private businesses increased by 7.6% of GDP. So the issue hasn't been not being able to borrow to invest. I think the issue has been low aggregate demand, and that businesses have been using their credit to find other avenues for profitability. And in large corporations, some of that would be things like share buybacks, increased share prices, etc. Next slide, please. The last slide is going to say, if we are in this situation and we're seeing our debt to GDP ratios going up, and we're seeing increasing risks globally in debt markets, especially for developing countries, and possibly the cost of debt going up, what is the response? And these charts are taken from the very new IMF October 2020 Financial Stability Report. And the graph on the left looks at central bank asset purchases in emerging markets. And this looks at basically central banks' purchases of government debt, and both primary and in the primary and secondary markets. We see that in the areas for those who are paying 6% or less interest rates, that South Africa and the South African Reserve Bank is a relatively small as a percentage of GDP, less than 1%. Of purchases, and central banks use quantitative easing to support financial stability and government spending. These measures have reduced borrowing costs and risks. The South African Reserve Bank's purchases of sovereign bonds was small to support financial liquidity, but not government spending and debt. The South African Reserve Bank limited interest rate cuts as well in response to fears that portfolio capital flows could increase. And we saw in South Africa and other developing countries large outflows of portfolio capital up to April, and a bit of a recovery since then. But if you look at the graph on the right, it looks at who's holding local government bonds. We see in South Africa, banks and residents bought government bonds, but non-residents sold the bonds. So there's room for state entities such as the Reserve Bank and the Government Employee Pension Fund, PIC, to increase SA government bonds in their portfolios to reduce and lower risk on government debt, and I believe at the same time lower their own risk to volatility and possible declines in the markets they are facing. I'll now pass on to my next colleague to present policy framework and plans. Thank you, Honorable Chair.
Thank you, Siraj. Good morning, Chairperson and honorable members. My name is Mapula Sekatani. I'm going to present the policy framework and plans. Next slide, please. Thank you. Here we look at the policy direction that needs to inform the budget proposals. So we look at the 2019 and to 2024 MTSF priorities, the 7 priorities by the MTSF, which indicates that the state we need to have a capable, ethical, and developmental states, economic transformation, job creation, education, skills and health, consolidating the social wage through reliable and quality basic services, spatial integration, human settlement and local government, social cohesion and safe communities, a better Africa and world. And then on the right-hand column, we have the economic and reconstruction recovery plan priority interventions that was introduced by the government, with the priorities that the government needs to implement in order to have the economy recover. When we compare the two, we look at the priorities of the economic reconstruction and recovery plan, we see that that is aligned to the second priority of the MTSF, which is a economic transformation and job creation. So we expect this to inform the budget going forward. But when we look at the MTBPS, there is no direct link of these priorities to the MTBPS. But then we see the link of the priorities to the budget function. Next slide, please. Next slide. So we see the spending priorities in the MTBPS being linked to the function groups over the medium term. So here we compare that with the supplementary budget that was introduced earlier in the year. And we find that in terms of the initial of the supplementary budget priorities, the government was responding to the COVID-19 pandemic, whereby the central aim was to save lives. So they had the 3 function groups that they were concentrating on, which was the primary health, social development, and peace and security. So now with the MTBPS, we see that we sort of going back to the basics in terms of the spending priorities with the function groups. So we still have the health, going back to the basics of looking at primary healthcare, immunization, HIV prevention and treatment, whereas with the supplementary budget, we're concentrating on saving lives and making sure that we're scaling up on capacity and public health systems. And then in terms of social development, we see that the government is still continuing in terms of the concentrating on the COVID-19 pandemic, whereby they are extending the special COVID-19 social relief of distress grant with an extra 3 months until the end of January 2021. And there is also a 1 billion that is allocated for food relief to vulnerable households. And we see that the responsibility for childhood development is transferred to the basic education sector. And in terms of peace and security, we see that the priorities are continuing to fight crimes and to ensure territorial integrity, and the reprioritization of funds to capacitate the information regulator. We also see an additional allocation of 63 million to the State Capture Commission for them to finish up on their investigation. And then we also have the other function groups reprioritizing. We see learning and culture concentrating on the planned infrastructure for higher education and FETs, universities that are supposed to be delivered in time and within budget, and the basic education committed to providing educational outcomes. We see the community development reviewing the programs related to the provision of mass housing, public transport standards, and the levels of free basic services, and the introduction of informal settlement upgrading partnership grant in 2021 for provinces and metropolitan areas. And for economic development, they are going to prioritize the finishing of outstanding restitution claims and the supporting of resettled farmers, and government and the tourism sector will collaborate in order to maintain the tourism assets. So in terms of the general public services, we see DPSA reprioritizing funds for personnel expenditure reviews in national, provincial, and local government, public entities, SOEs over the next 2 years. And in terms of DPE, Department of Public Enterprise, they're going to reprioritize funds, the Presidential State-Owned Enterprise Council, and an advisory body to assist with the strengthening of the state-owned companies. And there is also DPME, who's going to reprioritize funds to enhance public service reporting on planning and performance. Next slide, please. But then in terms of improving efficiency and composition of spending in the country, South Africa's public spending levels are not matched with the high levels of quality and efficiency in the service delivered. Government acknowledged that the proper implementation of program performance budgeting system is necessary, And the preliminary findings on the spending reviews, which forms part of the budget system, indicates that many policies are designed and adopted without considering their total cost and affordability. Multiple institutions share overlapping responsibilities or mandates, which leads to duplication of work in several high-spending procurement areas, including information and communication technology and infrastructure. It appears that government is overpaying for goods and services. The spending reviews will be used to inform the baseline allocation in the 2022 MTF period. And other analysis shows that shortcomings in the quality of data to determine efficiency. Policies such as the NHI district model depends on the outstanding interventions. So the current year revisions based on the COVID-19 fiscal impact support to SOEs and local government. Revision to the MTF based on stabilizing debt and reducing the budget balance. Next slide, please. So for the basis of revisions to the medium-term expenditure framework, these are based on the stabilizing of debt to GDP ratio, reducing non-interest spending mainly on compensation of employees. To ensure sustainability, high-level policy discussions are still needed on the followings: the number and the size of departments, ministries, and public entities in the national and provincial government, the management of function assigned to 3 spheres of government, containing of public service wage bill, the approaches to providing financial support to students in post-school education, the subsidy mix for urban transport system, the structure of human settlement delivery program, and the measures to strengthen the protection system for the most vulnerable. Thank you, Honorable Chair. I'll hand over to my colleague, Rashad Amra.
Rashad.
Hello, am I audible?
Yes, you are.
Okay, thank you. Apologies for that interruption. Honorable colleagues, I'm just going to be taking us through 2 slides on the fiscal framework outlooks. That was a quick summary of what was tabled last week, witnessed by the minister, as well as some a critique of it and identifying some of the risks and the credibility of this. So last week we had the MTBPS being presented, and it showed a further deterioration in the outlook for the fiscal framework compared to what was presented in February in the budget, as well as what was presented in the June supplementary budget. The graph on your screen on the top left, that's those 4 lines, shows the deterioration. The orange line is the MTBPS, and it shows a significant deterioration in the main budget deficit compared with the blue line, which is the budget review, and the red line, which was the supplementary budget. And it also shows the PBO's policy unadjusted outlook. So it's our estimate we did about a month ago, which is quite close to what was presented. And what it shows is that there's a much larger budget deficit expected, obviously, for this year and over the medium term. And this reflects the large and unprecedented downward revision to the growth outlook. And as we all know, this is primarily from the COVID pandemic and its implications for global growth and global demand, but also the effects on the South African economy arising in part because of the measures put in to reduce the spread of the virus. It also shows large reductions in revenue projections over the medium term. And again, revenue, as we all know, is a function of economic growth and economic activity. And so that's downwardly revised. And it also shows the effect of a reduction in interest expenditure over the medium term for the main budget as well as consolidated. The graph on the right-hand side, that's the 3 blue columns, or largely blue columns, decomposes the change in the fiscal outlook, comparing the MTBPS with the budget review. And as we can see, what dominates those columns is the blue blocks. The blue blocks show that the main contributor to the change in the budget balance is largely because of revenue. So it's largely a revenue effect over the medium term that's resulting in the large budget deficit compared with what was previously presented. Expenditure cuts, certainly over the 2nd and the 3rd year of the MTEF, showed that that's trying to reduce the budget deficit. So that's moving in the opposite direction to the revenue effect cumulatively. At the bottom of the page, we see the debt projection over the medium term, as well as the blue line on top of those columns, which is showing debt service costs as a share of total expenditure. Now, this is, as we note, this is much larger than what was projected over the in the budget review in February. And the other concern over here is the share of total revenue raised dedicated to debt service costs. And so now that's expected to exceed 23% over the medium term. And we know on a year to date, it's consuming more than a quarter of every rand raised in tax revenue. Can I move on to the next slide, please? Thank you. What the slide discusses is fiscal slippage and the credibility associated with the fiscal framework. So honorable members, as you know, for effective fiscal oversight, you need to interrogate as lawmakers the implications and the credibility of tabled money bills. My colleague Mapula has already discussed in part the potential impact of the fiscal framework, especially expenditure reduction. Excuse me?
No, continue.
On service delivery, and my colleague Suraj has discussed impacts on the fiscal framework on economic growth. Now, honorable colleagues, or honorable members, we know that government's stated fiscal medium-term objective is to stabilize debt as a share of GDP over the medium term. And for this, whatever is presented in the fiscal framework for the realization of this fiscal objective needs to be quite credible. It needs to present the most likely outcome given the levers government has at its disposal. However, and as we can see in this graph in front of you, our experience as a country in realizing our fiscal objectives has been one of fiscal slippage. That is to say, what we attempt to achieve and what we actually achieve, there's a wedge between those. There's a gap between those. And part of this is a result of exogenous factors that are somewhat or largely out of government's control, but some of it is within government's control. And it also speaks to proper fiscal planning and prudent management of public finances. So what we see over here in this graph is budget deficits. This graph presents debt levels, gross debt as a share of GDP, where we could do the same thing for budget deficits or non-interest expenditure over the medium term and primary balances. What it shows is that every colored line over there shows a projection from a different MTBPS, and the black line shows the actual outcome. So there is a notable gap between what is projected and what is achieved. And this reflects multiple factors. One, it reflects more optimistic growth forecast relative to outcome. And in noting that point, I would also like to accompany that point by noting the PBO's analysis on government's growth projections. And we note that whilst government is generally as accurate, if not more accurate than fellow forecasters, GDP growth forecasts have generally been more optimistic. That is to say, the outcome has been lower than the forecast. And so this raises some concerns about the credibility of the fiscal framework. It also shows revenue forecasts that are largely a result of growth forecasts combined with buoyancies and we've seen over there revenue outcomes being lower. So we've actually had revenue shortfalls in various years over the medium term. Now, the cost to the fiscus, but also the cost from a planning perspective from a fiscal framework that has credibility challenges. I wouldn't use strong language like saying it's not credible. The cost associated with this is high for the economy, it's high for planning, and it's high for the outlook and the sustainability of public finances over the medium term. So a simple example is that we had an estimate of us as a country realizing a primary surplus in 23-24 presented 4 months ago, and last week that was revised by pushing the primary surplus out by 2 years. So in the space of 4 months, we had significant changes in the outlook, and this again questions the credibility of our fiscal framework, generally speaking. Government notes, at least National Treasury notes in its fiscal risk statement, many of these risks associated with realizing the fiscal objectives over the medium term. And these risks are quite material, and the material impact of these risks has increased compared to previous years. So the one that's been noted and cited has been the outcome of wage negotiations, given that the MTF guidelines said a 0% increase over the medium term for the next 3 years. The outcome of this, again, is in part not in government's control, because this is a negotiation. So there's an exogenous factor over there. Similarly with global growth, and we saw the Euro countries noting lower growth over the medium term. And if there's a second wave or prolonged wave of the crisis, that will obviously affect the credibility of this fiscal framework and our ability to realize these objectives, given what's stated by government. And lastly, pressures emanating from other spheres of government, as well as SOEs, contingent liabilities, and also implicit liabilities arising from municipalities. So the point over here is that this particular fiscal framework has large material risks associated, and the costs are quite high compared to previous years with not being realized. Thank you. I'd like to now hand over to my colleagues to discuss revenue.
And you guys, you have exhausted your time, so let's give you 5 minutes, please. You'll deal with other things when you deal with the questions.
Okay. Sorry, Chairperson, I'll just quickly one point and then give my colleagues to finish. I think the slides on revenue, what you're just trying to say, we're just trying to show that there has been downward revision in expected tax to be collected over the year. But I think the point is that there is a proposal for additional tax measures to raise additional 40 billion over the year, over the medium term. But I think what's also important is wanted to emphasize the implications of some of these measures that are announced on tax revenue, in particular looking at the compensation of employees and so on. And the last point at the bottom there is there also been proposals by the Fire Commission to the President's or proposal to implement additional taxations over the to try to do some of the concerns in the sector. This slide, 2 points about this slide, the importance of realizing the policy shift in compensation employees. It has the implication it has of tax for personal income tax, because the public sector workers, public sector provide a high tax base of PIT and also very much stable revenue from PIT. So it's very important to take that into account. I'll give Dr. Lani to continue from there. Thank you.
Thank you, Dumisani. So good morning, honourable members. The next slide. The slide focuses on the revision to the 2020-21 non-interest expenditure. In the first row, you can see the original budget of 1.5 trillion, and during the supplementary budget, it was increased by 36 billion. In terms of the revised estimates, it was the new estimates are 1.57 trillion, and this has actually increased, or the COVID-19 fiscal relief package of 19.4 billion has now been allocated for employment creation, the extension of the COVID-19 social relief of distress grant, and some of the other increases in the 2020-21 financial year includes the increase of 10.5 billion to SAA. There was a rollover of 1.6 billion. And when you go down, there was also additional allocations to ICASA of 85 million. The Land Bank receives 74 million, and the South African Express receives 143 million. The above are all funded by the remainder of the COVID-19 social relief, that was 19.5 billion. And then there was also a reduction to the South African Airways allocation of 6.9 billion. And then there were the drawdowns, suspensions, and projected underspending is 6.7 billion over the medium term. Next slide. Just also to indicate, members, the allocations that I've just indicated does not indicate the revisions or some of the variants that has been made. We will still present that next week. And some of those main variants that were made is also additional allocations to the airports company, civil aviation, the IDT, and the infrastructure unit. So in terms of the revision to the 2020 consolidated expenditure, the compensation accounts for half of the total reductions in the current financial year. And then you will see debt service costs increased by 10.3% in the current financial year, but it even increases much more in the next financial year to 20.3%. And over the decade, government aims to protect funding for infrastructure investment and to build capacity for spending. And you can also see in the line for the payment for capital assets in the current financial year, there was an increase of 13.1%, and next year it will also increase to 13.4%. Next slide. Just to expand on some of the infrastructure spending and the interventions made, you will see there was 100 billion infrastructure fund announced in the 2019 MTBPS, and the Economic Reconstruction and Recovery Plan further provides for aggressive infrastructure investment, and also to establish a central government agency and to strengthen state capacity for infrastructure expansion. So basically what this whole story is telling us, that government is trying to move from compensation or other operational costs to spend more on capital in the current financial year, but also over the medium term. Next slide. Members, this slide is just showing the changes to the proportions allocated per budget function. And you will see, if we just look at the first function group, learning and culture, the proportion of the budget spent on learning and culture reduced from 20.7% in the 2017-18 budget, and it's estimated to increase to 19.2%. But what I want to also indicate to you is in terms of our health budget, the health budget is actually decreasing from 2017 from 12.3% to 11.5%. Something else to note is also the debt service cost, but that is the story throughout this whole presentation and the medium-term budget policy statement, is that the debt service cost increases from 10.5% and is estimated to reach 16.5% in 2023-24. Next slide. The next slide is showing the changes in terms of the economic classification of the budget. And as we said, is in terms of compensation, we estimate that the proportion that we spend on compensation will reduce from 35 to 30.6% over the medium term. Something else again to show is on the last one, the payment for financial assets. You can see that indicates the transfers to our SOCs, and there was a peak in the current financial year of 4.4% that we transferred to SOCs, but we estimate that that will reduce to 1.1% over the medium term. The next few slides are just showing the per capita spending, but we can skip these slides to give Fatsani an opportunity to present some of her findings.
When are you finishing?
In 2 minutes.
Okay.
Good morning, honorable members. I just wanted to highlight particular important implications of the downward pressure on the public sector wage bill due to the 5-year plan, the 5-year fiscal consolidation plan presented in the MTBPS and by the minister. So large reductions in compensation of public employees is justified by the explanation that expenditure on compensation has increased. It has generally been argued that the increase in compensation crowds out investment expenditure. Therefore, it is important to decrease the compensation expenditure. However, the share of compensation in total expenditure seen in our graph has declined from 38% in 2000-2001 to 33.9% in 2019-2020. Next slide. Over the MTEF period, all departments will be required to control wages and headcounts. They will have to review and rationalize their organizational structures to minimize the effects on frontline services such as doctors, nurses, teachers, and several other healthcare workers, and ensure that they remain within their compensation expenditure ceilings. In particular, more than 80% of the total compensation reductions is in the learning and culture, health, and peace and security functions. So if you see in the table, the 3 main areas are health and learning and culture, peace and security, where we will see large reductions in the teachers, doctors, nurses, and the police force essentially being reduced in the medium term. Much of the changes will take place at provincial departmental level, which means major restructuring of provincial budgets will be needed. Next slide. Next slide. Lastly, one of the big major risks to the current fiscal consolidation 5-year plan is that there will be pressure on the budget, the wage bill, based on the some of the wage freezes that would allow the unions to affect the way in which current wage agreements and upcoming wage talks will be affected. In particular, we note that to achieve the targets that the government has set in the MTEF, which are proposed as essential for fiscal sustainability, government has not implemented the third year of the 2018 wage agreement. Furthermore, the budget guidelines propose a wage freeze for the next 3 years to support fiscal consolidation. However, these broad sweeping cuts to the public sector wage bill may lead to clashes with public sector unions, affecting the current wage agreement and upcoming wage talks. So that's an important fiscal risk to the outlook on the possible fiscal consolidation path that the Treasury has presented as part of the MTBPS. Lastly, in conclusion, what we've decided is to, next slide, please. In conclusion, what we've decided to do is highlight key questions that have arisen out of presenting some of the aspects of the MTBPS, in particular, that the ambitious goal in the MTBPS is to quickly reduce public debt levels and achieve a primary surplus. This means that, to some extent, how much weight should be given to the forecast in the MTBPS? Is it prudent to plan such large expenditure cuts during an ongoing health and economic crisis? Will South Africa be able to build resilience, particularly for the poor, to future possible health, climate, and other crises that may arise? The possibility of prolonged labor conflict in the public sector due to wage freezes. This can affect the performance of the public sector and service delivery. With the current unemployment increase and the temporary 800,000 increase in job, are there any other plans to reduce unemployment? Will government expenditure cuts and possible debt reduction lead to an expected rise in business confidence during the current pandemic? Is there a plan to leverage infrastructure investment enough at a time when the private sector may not be willing to make long-term investments? Lastly, will infrastructure investment be enough to adequately deal with the collapse in aggregate demand as presented earlier by Dr. Siraj Mohammed about household income and consumption being constrained by not only the current environment, but the lack of economic growth? And I think that is the end of the presentation. Thank you.
Thank you, Team PBO. Can I then request the Financial and Fiscal Commission to make their own presentation, and please introduce yourselves, who's leading the team. Thank you. And who's there? Sure. FFC.
Hello, honorable members and colleagues. I hope you can hear me.
Yes, we can.
Thank you. My name is Michael Sachs. I'm the Deputy Chair of the FFC. As colleagues should know by now, we suffered the loss of our chair, Professor Daniel Plakis, who passed away untimely and unexpected a few weeks ago in October. So we did ask at the last meeting when the minister presented the MTBPS for a moment's silence in that meeting, which was observed. But just to note that we have Professor Plakis in our memory as we make this presentation, number one. And number two, we have written to the Speaker of Parliament to request that we host jointly between the FFC and Parliament a memorial event for Professor Plakis. Moving on to today's presentation, I think I would want to make the following observations in advance.
Mike?
Yes, sir.
Please also time yourself.
Okay, we'll try and be very speedily. So I would just like to make the following remarks. First of all, I think that we live in extraordinary times of great uncertainty. And when there is uncertainty, one of the things that should happen is that time horizons get shortened. So whereas usually in a medium-term budget policy statement, our concern should be over the medium term, given the shortening, given the uncertainty that we face, really the near term is more important. it's also the case that this year's budget, the current fiscal year is nearly over. So I think the first point I wanted to make is that I would urge Parliament to focus to a great extent on next year's budget and the numbers that we see for next year, rather than continuing to focus on this year's budget as well as the medium term. The real critical year is going to be next year. I think the Commission notes and welcomes the easing of the fiscal consolidation path proposed by the Minister compared to the special adjustment budget. So the non-interest expenditure cuts, as well as the path of stabilizing the increase in debt, have been eased, and the debt stabilization is now to be achieved over 5 years instead of 3 years, and that is welcome, because I think the extent of consolidation that was presented in the special adjustment budget was extremely harsh. So we welcome the easing of the fiscal consolidation targets. However, next year's budget cuts are eye-watering. And I want to give you some examples. The Department of Home Affairs next year will see its budget cut by 13.5%. The Department of Defense will see its budget cut next year by 9.3%. Legislative and executive services, which includes Parliament, will see its budget cut by 3.8%. So these kinds of cuts, where you see the nominal level of expenditure, the rand amount allocated drop in nominal terms, are unprecedented. They've never happened before in South Africa. We've seen real cuts on occasion before, but we've never seen nominal reductions in expenditure, and this will pose great challenges across government. I want to use the example of basic education. So basic education is not seeing a cut, but on a consolidated basis, according to the numbers in the MTBPS, basic education will have a 0% increase next year. So the budget that basic education had this year in rand terms will be the same as the budget they have next year. Of course, the Treasury and government is hoping that public servants will also agree to a 0% increase and that there will be a 0% increase in salaries. Let's assume that happens. Of course, in basic education, there are many other costs that you face. You have to pay for electricity, you have to pay for stationery, you have to pay for maintenance of your schoolyards. There are many other costs, and all of those costs will be increasing, but the budget available to schools will not be increasing. And so there's a very great danger that the quality of services provided to school children will fall as a result of this 0% increase. If, of course, after negotiations, government and Labour come together and the agreement is not for a 0% increase in wages, but let's say a 3% increase in wages, if that transpires and the budget still is contained at 0%, it means that there will be a real erosion in the quality of services provided to South Africans who depend on public education. Because the only option you will be leaving education departments is to reduce the number of teachers and reduce the number of staff in schools in order to accommodate above inflation or above zero wage increases. Now, there are two forces that are going to be imposing extreme pressure on budgets next year in 2021-22 fiscal year. The first is the need to hit expenditure targets, which the Treasury has laid out, the overall cap on expenditure. But the second is that added to this is a drive to shift expenditure from so-called consumption to so-called capital. And what this means is that departments of government that are engaged in consumption expenditure not only have to meet the burden of fiscal consolidation, but also have to have their expenditure shifted towards capital expenditure, which it is claimed drives growth. But when we ask what is consumption expenditure, the answer that comes about is that consumption expenditure is the core social services that government provides. So education is overwhelmingly consumption expenditure. Healthcare is overwhelmingly consumption expenditure, and policing is overwhelmingly consumption expenditure. So we're seeing those departments that provide core government services, health, education, and policing, placed under a double burden. Firstly, the burden of consolidation, and secondly, the burden imposed by their classification as consumption expenditure. So what this results in, and if you look at the division of revenue, is a big shift, a big reduction in the equitable share provided to local government and provincial government, combined with a big increase in conditional grants. And of course, conditional grants is what finances capital spending. So I think we're going to be facing a very difficult year next year. And I wanted to focus the committee's attention particularly on the budget that will be tabled on February and the numbers contained on that budget. And the key question to ask is, what is the impact on service delivery going to be? In realistic terms, whether we agree or disagree on fiscal consolidation and the extent of fiscal consolidation, the question to ask is it reasonable that to expect the Department of Basic Education to provide the same level of education that it did last year, given that it's going to, in real terms, have less money? So with those opening remarks, I wanted to invite the researchers of the FFC, starting with Mr. Tseng, to talk to us about the macro outlook, followed by Dr. Kululi Ngube, who will talk about the fiscal and local government outlook, followed by Mr. Eddie Rakabi, who will talk about fiscal risks. Over to you, Chen.
Thank you, Deputy Chairperson. Morning, honorable chairs and members. As the most recent data series shows, due to the COVID-19 pandemic and lockdown, GDP contracted in quarter on quarter, that is from Q2 of last year to Q2 of this year, by 16.5%. Financial indicator of the inflation rates year-on-year average remained relatively low and stable, albeit this is, one should note that this is in the headline. Core inflation, meaning the inflation and prices of essential goods, right? On the other hand, might be a different story. Although the official unemployment rate dropped from 29% to 23.3% in the second quarter of this year, this was, however, due to the fact that people were unable to engage in job search during the lockdown, resulting in a mass increase of the economically inactive population by 5.2 million just in one quarter of 2022. As a result, currently, there are more people of the working age between 16 to 64 years who are economically inactive than the labor force as inequality and poverty worsens. It is important, thus, to remember also that South Africa's fiscal performance weakened even before the onset of the pandemic, and it is set to deteriorate even more substantially over the medium term in gross debt to GDP ratio, caused by this sharp increase in primary deficit at 9.8% that needed financing, which incurs more debt and debt service costs at 4.8% of GDP for 2021. The plan or hope is, as earlier mentioned, that despite the 7.8% contraction in real GDP this year, the economy will quickly recover to 3.3% growth next year to taper the primary deficit and carry the debt burden, albeit with cost. However, the Commission notes that government's macroeconomic forecasts are generally over-optimistic. A series of budget review in this graph shows, and supplementary budget statements tabled before at this Parliament by the Minister show. This has had significant consequences for the credibility of MTEF's forward estimates and the fiscal levers for informing and achieving fiscal sustainability through prudence. The Commission further notes that real economic recovery can only be achieved through actual implementation of the reform plans as opposed to subjective sentiments of optimism or pessimism, or otherwise in this macroeconomic constellations series. Basically, one cannot plan or act with results in the absence of credible, accurate, and realistic projections. Thus, and finally, in the same way, instead of taking an overly ambitious fiscal position, policy position, such as the zero-based budgeting, what would be perhaps be more practical in terms of public finance management is the approach of costing and pricing of functions to align realistically and accurately public finance with outputs to achieve outcomes, as the former Commission Chairperson, Professor Daniel Plakis, always said. The Commission reads that government's economic plan for recovery is to forge a social partnership to boost confidence, restart the economy, and conduct urgent reforms as part of the 2019 strategy document, with focus areas of infrastructure and so on and so forth. In this regard, although the Commission appreciates this plan to be strengthening the continuity and consistency of position of the position taken, in line even with FFC's 21-22 annual submission for the divisional revenue table at this Parliament, specifically Chapter 3, Recommendation 1. However, we would like to note that consistency should not be confused with repetitions without proofs of real reforms, impacts, and outcomes, for it may lose us even more credibility of policy and that of implementation of government programs. For instance, the assumed recovery of a shock recovery at 3.3% growth just after the negative real GDP growth of 7.8 for the 2020 financial year seems extremely optimistic still, given historical trends. Gross fixed capital formation or investment, which is one of the fundamental factors for both the current and medium-term growth rates, had decelerated even before the onset of COVID and lockdown. Moreover, and related, in the MTBPS, the electricity availability factor remained unstable despite that demand decreased during the economic lockdown, causes concerns in terms of the credibility of the assumptions for infrastructure-led growth and growth prospects and the feasibility and viability of the economic plan itself. Finally, then, the Commission would like to reiterate, as stated in the 21-22 annual submission for the Divisional Revenue, Chapter 3, Recommendation 2, the Commission is convinced, we are convinced, and in agreement with government, after reviewing the economic situation leading up to the COVID-19 crisis, that a fundamental structural transformation of the economy is inevitable. Therefore, the Ministers of Finance, of Economic Development and Trade and Industry, and of Labor should jointly address the economic barriers, social inequality, and societal polarization by adopting a localized product value chain approach towards economic transformation and recovery. This means, more specifically, as an example, that hard conditions should be set upon grants frameworks to permit procurement of goods and products only if they are made or assembled locally within the South African borders to stimulate the domestic economy and encourage local job growth. I hand over to Dr. Ngube.
Thank you, Chen. I'm going to take honorable members and colleagues through the slides on the fiscal framework and touch on the local government issues later. Next slide, please. This particular slide assesses the allocations between compares the special adjustment budget and the MTBPS. And there are four things to note in this particular slide: that revenue projections will, in the coming year, will be lower by 4.6 billion. But as Commissioner Sachs has pointed out, the second point is that there's some slight easing of consolidation, which is welcome, because we see an addition of about 37 billion in the next financial year, and 66 billion in the 22-23 financial year. Those are welcome developments because they'll go a long way in cushioning poor households out of this economic downturn. Then the second point we want to highlight there is that if we look at all these additions, almost 3/4 of them are on non-interest expenditure, which is welcome. But the concerning issue there is the debt service cost, which are higher and they continue to crowd out. And the concern, especially in the following year, as we are going to see in the coming slides, is that this burden is being pushed to municipalities and provinces through the cuts in the early years, as we are going to see, and as what Commissioner Sachs has alluded to. Next slide, please. This slide simply analyzes the growth rate in non-interest expenditure. We see that next year, as we have pointed out, that next year will be a particularly difficult year. There will be a decline of 2.8% in non-interest expenditure. But we see a reprioritization or a clear prioritization of capital spending in next year. Payments to capital assets in that particular table will grow by 13.4%. So there is actually a prioritization, but that prioritization is not sustained over the MTF, as we can see that 23-24, it declines to around 2.1%, but there is a clear reprioritization in the following year, 21. Next slide, please. This particular slide actually tells us about the cuts which we are going to experience next year, as we have highlighted that 21 will be a particularly difficult year. We note there the cuts in the PES and the LES. And along those cuts, next year there will be some strong real increases in conditional grant allocations, which, as has been pointed out, there is some shift in the composition. We see some shift in the composition of spending from consumption, that is LES and the PS, which, as we know, it is spending on items like health, education, water, and sanitation in the local sphere. And there is a shift towards capital spending in the form of conditional grants in the following year. Yes, that shift is welcome towards conditional grants, but the concern is that government cannot abandon its core mandate of consumption spending, which is spending on health, education, water, and sanitation. Those are basic services which are needed. So the main question we are asking, especially looking at the cuts in the PS and the LES, is that how will provinces and municipalities absorb these cuts? And what are the implications on the delivery of services? We argue that even if all the efficiencies are exploited on these services.
I am not happy, I must say. I'm not happy with the breakdown of this into first 5 years and the second 5 years.
Hello. Can we please maintain focus, because the FFC is speaking here and someone else is interfering.
Hi. I'm chairing. Can we mute the operators? Can they mute everybody else who's not on the platform, who's not talking, please? Oral members and everybody who's on the platform, can I request again that we respect the speaker and make sure that our mics are muted, please.
Chairperson, on a point of order.
Yes.
Chair, I don't believe that the displaying of party logos and so on is acceptable in our meetings. I think that's a rule of Parliament. And I'm just looking at the Honourable Shivambu's profile picture that he has on display. I don't believe it's correct to have that as his profile picture in a sitting of a parliamentary committee.
I don't even see it for now, but I think we agreed that we don't show the party logos in our meetings. So
Chair, Chairperson, we've adopted the rules on virtual meetings. There's no rule that forbids me in that regard, by the way. So you must go and read the rules. You must not just make an objections without looking into the rules that guide this particular process. There is, of course, a rule that talks about wearing party regalia inside parliamentary precincts. But in terms of this process, he's speaking absolute rubbish.
Honorable members, please help the meeting, and so that we can allow the FFC to continue with its presentation. We'll check this one. So can you please proceed with the presentation, FFC? Thank you.
Thank you, Chair. The point I was highlighting is that there is actually evidence of shift in consumption in composition of spending from consumption spending to capital spending. And the question we are posing there is, how will provinces and municipalities absorb the cuts we see from the PS and the LES? Some of them are deep cuts, as we are going to see in the next slide. Next slide, simple highlights, puts these cuts into perspective. The issue of basic education under the learning and culture cluster there is, we see growth there in 21-22 is around 0. So unless the education sector is able to improve efficiency, such cuts will have some implications on the delivery of basic education. We see some cuts also in the peace and security function, more specifically defense and state security, and also policing there, which will grow by 0.5% in the, so something must give in. And what will give in? Will it be service delivery? So that's the question we are posing. The social development function will decrease by 1% in the 21 financial year 21-22. And more specifically, it is the social security funds which will drive that particular decrease. So in a nutshell, the Commission is concerned about the intended decreases in basic education, as well as in agriculture and rural development, which will decrease next year by 3.1%, as well as defense and security and social security funds. So we believe that even if all the efficiencies are exploited, these cuts will affect service delivery. And we are saying, the Commission is saying that the onus is on the key departments which are facing these particular cuts to indicate to Parliament how they will absorb these cuts, how will they deal with these cuts, or what will be forgone in terms of service delivery, especially in the light of these severe cuts. Next slide. This slide summarizes the fiscal framework, highlighting some key important factors. First, the Commission welcomes the slight easing of the consolidation path, which we have seen some addition to non-interest expenditures, which, if you look at the additions, almost 3/4 of them go to non-interest expenditure. It's a welcome thing. But we are saying that despite these additions, the cuts are concerning, especially on the equitable share allocations, both for the provinces and the local government sector. These cuts will actually hit hard the health, education, water and sanitation, and other basic services, which we believe are the core mandate of government. And we are also noting that provinces and municipalities should come up with the plans and report on how these reductions on the PS and LES will be managed. And also these plans must highlight how service delivery will be affected. And the main concern also is on the adjustment decreases in basic education, agriculture, and defense and social security funds, especially basic education, because it is an important sector in terms of skills development and in terms of even addressing some of the issues which are highlighted in the economic recovery program. So The Commission recommends that the implications of these budget cuts for the affected departments be detailed so that we understand the implications of these and what measures can be taken to mitigate the negative effects. Next slide. The next slides look at local government fiscal framework. And on the local government fiscal framework, next slide, Ken. On the local government framework, we see that the local government is set to receive about 434 billion over the 2021 MTF, and the resources to this sector will increase by 2.1%, but that is actually lower than what is projected of the inflation levels going forward. But many municipalities continue to face severe distress. They are facing spiral debt crisis, huge revenue gaps, unfunded mandates, and even poor audit outcomes, and the COVID pandemic has aggravated their situation. But looking at the MTBPS, it is proposing major cuts to the local government sphere, and as has been noted out there, we see that the local government equitable share next year will decrease by, in nominal terms, by 9%, which I think is concern. But overall, the Commission is of the view that there's a need for stakeholders to revisit or relook at the local government fiscal framework, especially considering that the allocations are going down, and also it is difficult for some municipalities to raise revenues. So there's a need to have a relook of the local government fiscal framework so that it responds adequately to some disparities like rural-urban disparities. We have seen the rural-urban tensions around the equitable share. So the local government fiscal framework must respond to such tensions and also to respond adequately to the revenue bases, which are getting thinner and thinner, while at the same point transfers are falling. So the local government fiscal framework has to respond to that, and also it must respond to realistic costing of basic services. Next slide. This particular slide is really more telling, these particular graphs. They show the local government equitable share and the conditional grants. We see in the current year, conditional grants have fallen, but they increase next year. But the local government equitable share will fall drastically in 2021, which is a concern. And as we have said before, that is that shift from consumption expenditure to capital expenditure. And those graphs below highlight these cuts in real terms, real growth rates of the local government equitable share, bottom panel on the left and on the right. These are severe cuts which will have some implications on service delivery going forward, and in particular in 2021. Next slide. In 2020, we are saying that the supplementary budget had received an addition of 11 billion to the local government, which was added to the local government equitable share. And there were also some additions in the grants, but the MTF, over the 21 MTF, we see some, actually the LES being affected. And next year in particular is a crunch year. And so the Commission notes the proposed allocations and downward revisions of previously announced allocations, and it remains concerned about the effects of these reductions on service delivery, and also considering that the bulk cost, especially on water, electricity, will not fall by the same margin, or they will not fall, but they will go up. So the LES is falling, but we know that water and electricity will not fall by the same margin, but instead they will increase. And also the Commission notes and is concerned about the reprioritization of local government funds to fund SOEs, especially the local government sector has to contribute to the rescue plan for SAA about more than 400 million. So the Commission is concerned with that one. And it is also concerned about the proposed cuts on conditional grants, especially in the current year, as they are going to go against the economic recovery plan, which is infrastructure driven. Next slide, please. This particular slide shows the baseline reductions over time. And the point we want to make there is that these repeated baseline cuts will have negative effects on service delivery, infrastructure investment, in particular repairs and maintenance, which are a soft target. And it also goes against the government's objective of infrastructure-led growth. So the Commission is of the view that government should assess the effect of baseline reductions before implementing the planned reductions over the MTF. So the repeated baseline reductions are a concern and they will affect service delivery in the long run. Next slide. So in summary, on the local government issues, we are saying that these reductions to the local government equitable share next year and perennial cuts in conditional grants will compound the local government challenges. And the concern is also this 440 million, which will be the local government's contribution to the 10.5 billion to SA to implement its rescue plan. So the Commission notes that, and we are saying that it is really similar to taking away resources from the poor to serve the well-to-do. The local government equitable share will decline by 9% next year. It is unclear how local government will maintain services to poor households, and obviously something must give in. Will it be services which are delivered by local government? And we are even arguing that even if all the efficiencies are exploited, these cuts, especially next year, will curtail the delivery of services. And also repeated cuts in conditional grants will affect service delivery in the long run. But so the Commission implores the government to prioritize local government and by implication, the poor households. And on the part of the local government, the Commission is saying that the sector, or is arguing that the sector must also utilize available resources more efficiently. And the sector must aim at striking a good balance between what is core and administrative staffing, so that there is a good balance between the two. And in many cases, we find that there is more money being spent on administrative issues than the core mandate of the sector. There's also a need to institutionalize consequence management. And more important is to strengthen the capabilities of oversight institutions in municipalities. We saw the abuse of resources, and mainly it was also a result of weak institutions, oversight institutions in municipalities. And on the district development model, which is we see as a very important component or development in terms of fixing the perennial problems of planning and coordination across different spheres. But we note that the MTBPS is silent on how this particular model, the district development model, will be resourced. And the argument is there is that for this initiative to be effective and for it to play a part in catalyzing local economic development and support the economic recovery plan, it is important that the government provides clarity on its operational modalities and provides the initiative with the necessary resources. Next slide is for my colleague Eddie to take us through the last slides. Thank you.
Thank you, Chairperson. I'm going to take you through the last remaining two slides. The first one focusing on the fiscal risk to the fiscal framework. The first one, I think, is the wage bill. We very well know that the wage bill has been dominating the discourse as one of the greatest risks to fiscal sustainability. But just to really draw the member to the attention of the table that is displayed on the screen there, we see that compensation of employee as a percentage of total spending has actually been declining over the years and is even projected to reach about 30% in 2023-24 financial year. But if you look at compensation of employees as a percentage of revenue, it's really interesting there. So what we're seeing is that because revenue has not been doing very well, so compensation of employees is eating into that revenue. So essentially what has happened was that we've had input cost increases while revenue has remained stagnant, but we've managed to sustain compensation of employee or by borrowing. So what has happened is that instead of managing the input cost by adjusting the cost on the on the input side, we've been borrowing in order to finance compensation of employees. That's the situation that we find ourselves in. So essentially the point that the Commission is really trying to make here is that the fiscal framework that is tabled in the MTBPS hinges on the ability of the economy to grow much faster and actually be able to afford or to finance the compensation of employees. And if the economy is not able to recover fast enough, so we're very likely to see the wage bill even crowding out spending as we're currently seeing. Next slide, please. The next slide just shows the feasibility of the wage freeze agreement. So essentially, the point that we really like to make, the Commission is really like to make, is that the unilateral pronouncement on the wage freeze by government undermines the legitimacy of the PSCB structures, especially to discuss and resolve public sector remuneration issues. So the lack of resolution on the wage freeze by all parties concerned generate uncertainties over implementation and questions its feasibility. So the fiscal framework that was tabled, as I said, hinges on the government's unilateral decision to freeze the wage bill. But in the absence of that, if should the unions not be able to amenable to that proposal, so we're very likely to see the fiscal targets that were tabled by the government not being reached, basically. So government in this case really needs to strike a deal with labor in order to control the wage bill. In the absence of that, an agreement will most likely undermine the economic recovery program of government. Next slide, please. The next slide focuses on the government guarantees and exposure to the SOE. So we have seen recently, I think, over the government guarantees increased from 470 billion to about 484 billion in between 2017 and 2019. And recently, we've in the MTBPS, we've had the Minister of Finance allocating an additional 10 billion to SAA. And recently, we've had the ESCOM announcing results. They're projecting a 22 billion rand loss for the current financial year. So essentially, what we're saying here is that if we don't really deal, if there is no strategy to deal with the underperformance, financial underperformance of the state-owned enterprises, again, we're going to see really greatest risk to the fiscal framework. So in other words, we're even going to see even much more bigger cuts coming in, or in the case of what we have seen with the SAA, where key delivery departments had to cut their budget in order to accommodate the bailout to SAA. So essentially here, the Commission recommends that the speedy establishment of the proposed Presidential State-Owned Enterprise Council, whose task is to provide strategic oversight of SOEs, ensure that their dependence on the fiscals is reduced by addressing their financial and operational business model, as well as the people challenges, but also ensure their rationalization. So the FFC recommends that this should be attended as a matter of urgency. The Commission has reiterated this point on many times, but we continue to see more and more of these
financial underperformance of the SOE without any solution in sight. So without any proposal to address these challenges, we may very well likely to see the fiscal framework going forward that has been tabled undermined. Next slide, please. The next slide really just here is just to hide. We tried to look at some of the performance of the economic relief package that was tabled by the Minister of Finance in the supplementary budget. Essentially, the point what we really like to make here is that as much as the relief was a welcome development to cushion the economy against the impact of COVID-19 and the lockdown, what has happened was that we note that there was a slow uptake, delays in the disbursement of funds, as well as overpayment, non-payment of beneficiaries, payment of incorrect beneficiaries, as well as corruption are characterizing some of the programs of the economic relief package. So in a sense, as much as the program had well intentions, because of all these administrative inefficiencies, it is not making the impact that it is supposed to be making. And just as an illustration, we show here with the business loan guarantee scheme, by the amount of applications that were received versus the amount of applications approved. Essentially, many of the businesses were unable to qualify for this particular instrument largely because of the financial records they've got. They do not have very good financial records, and they've got impaired credit records. So those are some of the administrative inefficiencies that need to be addressed if we really want to see the economic relief package making an impact. And one of the greatest concerns that we really like to highlight here was that when we had the meeting with the National Treasury and some of the government departments to ascertain the availability of data in order for us to measure the impact of this, we're really concerned by the fact that there was really not much information available, real-time information available for us to be able to carry out impact analysis of this particular instrument. So now we've got these huge, massive interventions, but we're unable to determine whether it's really making an impact or not because of the absence of performance data. That's what we really want to highlight to the members. Next slide, please. Going forward, given the cuts, the expenditure reduction, the cuts that my colleagues have already indicated, so the Commission here is of the view that some elements of the economic relief or the stimulus needs to be extended into 20 financial year to mitigate the effect of COVID-19, because it's very unlikely that within the limited budget cycle for this current financial year that all of those instruments associated with the economic relief package will be exhausted. So we are proposing that some of those elements should then be continued into the next financial year, as we've already indicated that that's where really the impact will be felt by some of the departments, by some of the big social departments. Next slide, please. The next set of slides is just really here to indicate the alignment of the budget to economic policy intervention in particular the economic recovery and reconstruction programs that were tabled by the President recently. The Commission broadly is in agreement with the economic recovery and reconstruction plan. So in this case, we sought to ascertain the extent to which some of the departments which are key to driving spending to ensure that the economic recovery is implemented, whether the extent to which they are spending and actually having programs to ensure that the recovery plan achieve its intended objectives. Next slide, please. The next slide, we just did a simple assessment of the expenditure analysis, the extent to which some of the departments has been spending over time. So here what we see is really mixed result, especially in relation to the departments that are crucial to driving the economic recovery and reconstruction program. For instance, if you look at the Department of Trade and Industry, for instance, within a six-month period under review, the trade industry has only spent about 36% of its allocated budget. But when you look at small business development, it appears that because of some of the interventions that the department has had introduced in order to respond to COVID-19 lockdown, the department was able to spend way above the smoothing trajectory. So all the departments were expected to have spent about 50% by by September this year. But in the assessment, what you could see there is really mixed results. So essentially the point we're driving here at is that the departments which are crucial to driving the economic recovery and reconstruction should really be at the forefront of spending money to ensure that the money is released into the economy as rapidly and as fast as possible. Next slide, please. The next slide here is just really to re-emphasize the point that I was making, especially in relation to the department that we say are key to driving the economic reconstruction and recovery plan: agriculture, communication, public works, for instance. So we need to really start seeing those departments, spending performance of those departments improving to ensure that the economic recovery and reconstruction plan is realized. So
very much, sorry, very much on injury time, please.
Yeah, can I just move to? I'll probably move to just the last two slides. The slide on. Yeah. Okay, thanks, Chairperson. This is just the last slide. Here we just made a simple assessment of the feasibility of implementing the zero-based budgeting, as it was recently announced by the Minister of Finance, as a way to really improve allocative and spending efficiencies. So essentially, the Commission here agrees that if it's well implemented, the zero-based budgeting is most likely to yield significant saving and reduce program inefficiencies. But it really is something that cannot be done overnight. So really, the caution that we really the message that we really like to make is that government need to exercise caution before implementing zero-based budgeting, as it is fraught with multiple implementation risks and challenges. In particular, it is really costly, it is complex, it is time-consuming. We currently have a situation where some municipalities are even unable to develop budget within the budget cycle that they are given. So to move into something that drastic like this, it really be challenging for some of the municipalities and even provincial departments. In conclusion, Chairperson, the Commission welcomes the slight easing of the fiscal consolidation stance to cushion the impact of the economic downturn. We also note the projected stagnant and expenditure reduction on cost spending functions for the 2020-21 financial year. The budget is susceptible to uncertainty due to the unresolved wage agreement budget proposals. Secondly, thirdly, is that spending departments need to indicate to Parliament how they intend to absorb the budget cuts and minimize the impact on service delivery. There's also a need for improved alignment between the budget and economic policy interventions. And lastly, is that the infrastructure-led approach that is identified in the economic recovery plan hinges on better infrastructure delivery management across all government spheres and the building of capacity for infrastructure development. Finally, is that there is a need for stakeholders to revisit the local government fiscal framework and even the assumptions underpinning the current division of revenue to ensure that it is effectively responds to the development challenges such as rural and urban disparities, revenue bases that are increasingly shrinking in the context of equally diminishing pool of resources available for sharing. Thank you, Chairperson. I'll leave the presentation there. Thank you very much.
Thanks, Chair. I just wanted to acknowledge the presence of my colleagues Trevor Fowler, Lawrence Erasmus, and Aubrey Mukadi, are my fellow commissioners, and I hand over back to you. Thank you very much.
Thank you so much, Team FFC, and I welcome the other commissioners. Honorable members, I will be handing over to Honorable Mahlangu to continue with the meeting. But what we are going to do, I requested that please raise your hands in the platform so that we can recognize all of you, so that we can determine how much time that we are going to give you. I've got Honorable Floyd Shivambu, I've got Honorable Dutoit, Honorable Kaiso.
Thank you, ma'am.
Honorable Sheikh. If you can't raise it here, okay, you must just shout. But I wanted to see your hands here. I've got Honorable Sheikh. Who else? Honorable members.
Chairperson Dennis Joseph.
Honorable Joseph.
I see Honorable Njatu as well, Chair.
Honorable Njatu.
Honorable
who?
Honorable Njatu, Honorable Maswanganye, and Honorable Peters.
Honorable Peters.
Chair, there's Honorable Sarupan as well.
Honorable Sarupan. Are we leaving out anybody? Honorable members? Okay. Honorable members, can you try to confine our questions for the first bite to 2 minutes, and then we'll see how far we go. We can have a second bite, but I'm handing over to Honorable Mahlang. Honorable Mahlang, are you there? Okay, Honorable Shimbabu, please.
Thank you very much. Thank you very much, Chair. Just a few reflections is that one, any budgeting or budgeting process of government that is premised on a supposition that you can freeze or reduce the wage bill is illusionary. So I don't think that anyone must even think that there will be ever a possibility of freezing the wage bill. It won't happen. And so any form of budgeting must always factor in the fact that salaries of public servants must increase, because if you don't increase them, you're making the public servants poorer. And that is not something we're going to agree on. So that is one thing that we must then deal with in terms of the first issue. And then the second issue that I want to raise, Chair, is what is raised by the Fiscal Commission in terms of localization, that we need to adopt a localized product value chain in terms of what should happen. And they specifically say that the Ministry of Finance and Trade and Industry should look into that. Don't you think that localization and procurement should be elevated into legislative instruments, like even effective amendment of the PFMA and MFMA to say that it's compulsory that a certain components of all state procurement from local to national spheres of government must be locally made, because this voluntary localization doesn't seem to happen. The Department of Trade and Industry has got regulations around the issue of localization, but that is not being complied to, and there isn't an increased economic activity in South Africa. And another issue which we want to look into is that a growing number of municipalities are owing ESCOM one, but also are owing now water boards. Would it be a better approach to top slice their budget in their equitable share, to say that instead of giving you what fully is due to you, can we deduct the money which is due to ESCOM and the water boards, so that we can then prevent all of these issues? And then I want lastly a general reflection on these budget cuts. Aren't they an austerity measure which is going to shrink the economy and thereafter shrink the revenue base of the state? Because austerity has proven to be not working in all other parts of the world where there's been an attempt to impose budget cuts as a response to an economic crisis. It has never worked anywhere. I want to hear what the PBO and FFC want to say in that regard.
Thank you. Honorable Detroit.
General.
Thank you, Honorable Chair. Honorable Chair, a question to Rashad Amram with regards to fiscal slippage. Would you agree that the following could contribute to fiscal slippage? Expropriation without compensation, the investor uncertainty that we will have as a result of that, and service delivery protests due to lack of water supply and the unstable electricity supply and the failing municipalities. And then to the PBO and the FFC, I want to know, according to you, when might we see a rise in inflation? Since we're currently sitting with a very unstable financial situation in the country, and obviously we are trying to keep interest rates as low as possible for as long as possible to try and stimulate the economy for business to take place. What is your estimates on this? Thank you, Chair.
Thank you, Honorable Detroit. Honorable Kaiso.
Thank you very much, Chair, and welcome the presentations. The few points that I want to raise here, Chair, is that let me start with this one of the absence of performance data from the Treasury. I think we're going to have a problem with that, Honorable Chair, that if Treasury would refuse to provide necessary data so that we are able to can do proper, assessment and provide proper guidance, and it's going to be a very serious problem. So one would suggest that let Treasury provide that performance data so that as we urge way forward, we are able to understand from which basis are they moving, such that we don't just simply get incomplete data. Yes. Now on the issue of, I don't think it's necessary that each and every time at this level we are going to engage on issues which are related to wage negotiations at the level of the portfolio committee, because it brings a problem every time that now the issues of bargaining are reduced to this level. So it is advisable that the issues of which are related to issues of wage negotiations are referred back to the Public Service Coordinating Bargaining Council, because then it will definitely undermine that council if they are reduced to this level, and where there's a unilateral pronouncement will be made, it is going to be a problem. So. And the other issue is on the district development model. I don't know why is it the MTBPS is silent on that, Honorable Chair, that it's very important and very key towards the development. So we can't miss that point. It has to be elevated. If I'm to say, if there's any other thing, it is this one of the district development model. It must find its expression. On 440 million contribution by the local government.
Honorable Kaiso.
Thank you very much. I'll come back at a later stage.
Okay, thanks. Honorable Sheikh.
Yeah, thank you very much, and thank you very much for the presentation, both from FFC and PBO. My first question is this: based on everything, all the evidence in front of you, with the serious challenges we speak about in the country in terms of the unions giving us a problem, and rightfully so, because you can't just go and freeze the wage bill and reduce the quality of life of our people, which is going to cause a high unemployment rate in the country. There's no doubt about it. Of course, you are correct that the skills people will have to start leaving government, and we're going to lose them, and countries abroad are going to start taking them on. Do you really believe that what we have heard from the Minister of Finance is achievable or not achievable? In my view, no. Now, based on all these things before me, I believe there's only one way that we can get the resources to be able to deal with the challenges, and just one way. And that is if we tighten up on the procurement, because it is clear that we are losing hundreds of billions of rands. And your amendment to the procurement bill is not good enough to deal with that. Maybe we should be focusing on that. If we could focus on that, and then strengthen the municipalities to make themselves sufficient. At the moment, they are all in chaos because they do not collect enough revenue. They are deeply in debt, and that's going to be another serious problem. Should we not then concentrate on making them self-sufficient? In terms of education, I want to say, and I'll share there's a whole lot, but I'm just going to stop on the issue of education. Already, 60% of those going to tertiary institutions in the first year drop out, which is costing us billions of rands. That is already as a result of the quality of education at basic education level. What impact is this reduction in revenue? Well, not actually a reduction, but in the increase in the costs and things, and no increase in budget allocation to them, is now going to have an impact if 60% drop out in the first year. I'll stop there for now, Chair.
Thank you, Honorable Sheikh. Honorable Joseph. Honorable Joseph.
Thank you, Chairperson. I just have 3 points to raise. The first thing is I would like to know if Parliament Budget Office or the FFC have done a breakdown on the 10.5 billion that goes to SAA. I heard something, the Minister spoke something on the radio. The Minister of Finance didn't give the breakdown, but the Minister of Public Enterprises alluded to some information, but I would like to know if there was a research done and what it is. What is it money going to be used for? Secondly, Chairperson, the 5 billion new taxes that the Minister announced, that 5 billion from next year and then 10 billion going forward. I'd like to know if PBO and FFC have an idea where that money can be found, or what is their views, where are there still opportunities. I've also asked this to trade and industry. And then I want to follow up on my previous colleague who spoke about the 440 million, or the role of local government, or the decrease of local government money, which is a serious concern that we have to consider as a committee. Local government is the future and the coalface and all the challenges. We must consider not to take money away from local government. And then I've also noted the increase to state guarantees is a concern. And then I also, my last point, Chairperson, I noted that there's a negative, if I'm correct, there's a negative view coming from Parliament Budget Office and FFC around zero-based budgeting. And I know the Minister said it's a long-term strategy. It is something that we must pursue. We must investigate, put a task team together and look at 3-5 years from now when we can start implement. But that is a necessity to investigate. So I would like to know why both institutions have a more negative view towards it, as if it would collapse government. Obviously it will if you don't manage it properly. But in all, it is not good to deal with this money that the Minister announced on the adjustment budget. I understand COVID-19, but overall government is not managing the finance as well. Thank you, Chairperson.
Thank you, Honorable Joseph. Honorable Jadu. Honorable Jadu. Okay, have I lost you? Okay, we'll come back. Honorable Masongai. Thank you, Chairperson, colleagues. To a certain extent, Honorable Joseph has covered me. SAA and the money that is ever allocated to SAA. I, for one, am quite very worried because last year, 2019, they got, I think, around 11 billion. And now it's 10.5 billion, which is almost 22.2 billion. I have to verify the facts. What is this money used for, as Honorable Joseph has asked? Because we can't always pass a fiscal framework vote, I mean a report, and not be given breakdown what the money is for. We agree that SOEs should be surveyed, but we have got to be given explanation. Where does the money go to? 10 billion is a lot of money for one SOE. So at some stage, as colleagues are suggesting, we have to get the breakdown, Chairperson. I'm quite worried because now it's eroding, it's going into local government. Look, if they say the budget of basic education is not going to increase, what is the priority of this government? Because human development is a major priority of any government. But now, even human development gets neglected. We're going into serious trouble, Chairperson. So I think at some stage, we need the explanation, as colleagues have asked the question, on the SOE, but on SAA in particular, because the concern is getting strong outside in the public domain. But ourselves, as public representatives, we need to be given a breakdown and be given a rationale why is such a big money being allocated to one entity. Thanks, Chairperson.
Thank you, Honorable Maswanganye. Honorable Peters.
Thank you, Chairperson. I would also want to join those who would like to thank the FFC as well as the PBO for their presentations. And I've got just a short question for PBO. In your slide 29, you do indicate that health budget is decreasing. And throughout your presentation, I've never heard any mention of the national health insurance. And what is your view with regard to the implementation of the NHI if this health budget is decreasing? You also mentioned that the wage bill and the debt service cost is increasing. In essence, is the PBO saying to South Africans today that the South African budget is enough for paying debt and compensating public servants? And to the FFC, how does the president's pronouncement on the teacher assistance, the more than 300,000 that he mentioned, and other categories of workers that would be in the public sector in the 800,000, how do that impact on the public service wage bill? But also there is one colleague who has mentioned it's Honorable Joseph, spoke about the issue of localization and the department, I don't know whether it's him, but somebody said it, the role of the DTI. But I just want to know from the FFC, what do you think prevents South Africa to support locally produced products? Because this localization has been spoken about, there was a strategy that was developed, and still we keep on talking about supporting local, and it doesn't seem to be happening. But also lastly, Chairperson, I want to join Honorable Maswanganye with regard to that it's just don't ring well in my mind that we can take money from local government and give it to SAA. And I just want to understand and probably support the call for the operationalization of this presidential SOE Council, as if it will be a panacea for the challenges of the SOE. But local government, Chairperson, has got serious service delivery challenges. You've got challenges of the road infrastructure, the infrastructure for electrification, the infrastructure for water. Communities are at all times sitting with challenges of taps being there, but no water flowing through. And we've got serious challenges of electricity infrastructure that is so weak that a small wind would just blow off the currents. And it is not at all times load shedding, like people would always say, when the lights are off or when electricity is off, is load shedding. It is not load shedding. It's the infrastructure at local government for distribution of electricity that is actually a challenge. How does it augur well for us to say that we can take those little resources that are supposed to cover that, then be able to save the SOEs? I think the SOEs need a special discussion on its own, like we always do, but we have never resolved on how do we deal with this many SOEs and how do we manage to get them to be a self-sufficient. And I think it is important that we also need to engage. Okay, thank you, Chairperson. We need to engage with labor with regard to this. Is it fair to keep sustaining some of the SOEs just to keep the people in the jobs, which speaks to my first point about money for debt as well as money for wages. Thank you, Chair.
Okay, honorable members, let me be generous. Can I give you? I'll start with Honorable Shivambu on if you have got one burning question that you'd like to add.
I'm back now. Okay.
No, Chair. I'm thinking that because the Standing Committee Chair on Finance, Comrade Joe, says what is SAA doing about that matter. Well, let's call SAA to come and tell us what did they do with the 16 billion rand that were given from the fiscals, and what are they going to do with the 10.5 billion now? So instead of asking broad rhetorical questions, we've got the power as Parliament to get SAA to come and tell us what is the plan, because we do not want the 10.5 billion now to go into a sieve and the airline is still not saved. Let us have maybe that as part of the interventions moving forward.
Thank you. Honorable Tutoit, do you have a question?
I'm also back.
Okay, I saw you, Honorable. Let me just finish. Honorable Tutoit. Okay, Honorable Kaiso.
Yes, Honorable Chair. I also wanted to talk about the issue of the equitable share, that 440 million, in my understanding, actually was not supposed to be a start to take a cut from the local government. Based on what already my colleagues have said, I don't think really it's advisable that we go cripple the local government in terms of the equitable share. That was the last point that I wanted to raise. Agree, Honorable Chair.
Honorable Sheikh.
Yes, thank you very much, Chair. My concern is this new district development model. Could you advise us what is your understanding of it? Because for me, it would appear that it's becoming like a fourth-tier government, which is now going to shoot up the high levels of compensation to employees particularly. And finally, you know, the president has gone on saying that he's going to be employing 300,000 plus another 60,000 plus another 3,000, but we want to reduce the public sector wage bill. Can you please advise us what is your understanding of this?
Honorable Joseph.
On cover, Chair, thank you very much.
Honorable Sangai.
Hi, you're right, Sheng.
Honorable Peters.
Nam to right, Chairperson.
Honorable Sarupen, I jumped you. Please come in. We've got more time.
Thank you very much, Chair. And again, sorry about the camera, but my bandwidth issues persist. Chair, on slide 37 of the PBO's presentation, they did give us their conclusions. And they questioned generally the government's expenditure cuts, particularly around the wage bill and whether infrastructure spend is going to result in the aggregate demand that we need. And it gives us one view. But the FFC, on their presentation on slide, I just want to look at the number, on slide 23, on the feasibility of the wage freeze, says that government needs to strike a deal with labor in order to control the wage bill. In the absence of such agreement will undermine the government's economic recovery program. So we've got two contradictory opinions here from two different bodies. So I'd really like to understand from the PBO on what basis they've modeled aggregate demands in relation to the public sector wage bill. And considering that the bulk of employment in this country is not in the public sector, I think it's 23% of the public sector and the rest is outside of the public sector, how they square that circle in their presentation. And I'd like to fully understand why they've come to the position that they're not in favor of public service wage bill cuts. Thank you, Chair.
Thank you. Honorable Judge, please come in. We've got more time.
Thank you, Chair. Mine is very specific, Chair. It is on the budget cuts 2021. And also the zero increase, which is affecting a number of departments. So my point will be that FFC and PBO to give us clear recommendations and more detail in terms of going forward, so that when we move to the budget of 2021, that we have a more clear understanding as how these implications will be. If you look in terms of how major departments will be affected, an example, education. So I think it's a number of, it's a little bit of, it's a concern. So if you could get more in terms of, for us as an oversight, to be able to know exactly how to do and to make interventions. Thank you very much, Chair.
Thank you. Honorable Masango, are you there? Okay, can I add to your basket of questions? This both PBO and FFC. I just want to hear your comment that we are aiming to have a primary surplus. What is 24-25. In your opinion, with all the challenges that we're having, do you think that's a good objective to put ourselves? And what are the implications for other things? Then my other question will be, it's very clear that the answer to our economic woes and the fiscal challenges is it's economic growth, inclusive economic growth, and using all your resources, both capital and human capital resources, to grow the economy. But do you think that the tools that we are having, the legislation that we are having, is helping that? Obviously, I don't think so. But again, there is a procurement, a public procurement bill. I want to check with both the FFC and the PPO. Have you looked at that bill, and do you think it assists us to localize and grow the local economy? As we all know, what may seem cheap to import from China may end up medium to long term being very, very expensive. FFC, you have raised a number of areas where you are decrying the fact that there are so many reductions, right? But where we seem to be a very thin on, it's if you don't cut, what should happen? Perhaps related to that, what are the other sources of funding that we should have? Because if you don't cut, obviously it means you must maintain your expenditure. So, Honorable Shivambu, please mute your things. Honorable Shivambu, please mute your video and your Honorable Shivambu.
I'm muted, Chair.
Your video. Yeah, born. Oh, thank you. Yeah, I was then saying FFC are raising very sharply the issues of the reduction and the cuts that are being proposed. But where you are very tenuous and thin is to say, what should we do? Where should money come from? You are not saying anything about other source of funding, perhaps that we may need to consider. Related to that, there was a slide which was presented by PPO, where it spoke about the South African Reserve Bank being involved in both the primary and secondary bond market, and perhaps all other fundings. What's your comment on that? Obviously, we need money if we are to maintain all of this. I would like to hear FFC talking about, because there was that slide which was comparing the intervention of the central banks in the world, comparing with ours. I would like to hear your comment. So we'll start with PBO. PBO, the time is about 11:15. If by 22 we are done, so that we can give FFC time to continue from there. PBO?
Chairperson, on a point of order.
Yes.
I had my hand up. I wanted to ask a question.
Sorry, I didn't see.
Okay, thank you. May I ask my question?
Please continue, remember.
Thank you very much, Chair. A lot's been said about the state-owned enterprises and SAA, and I won't repeat it. But I do agree that we should get SAA or whatever entity is going to get the money to come before the committee and explain it, because the minister says it's not a bailout, but of course it looks like a bailout, so it's very confusing. So I agree with that proposal that we get that entity to come to the committee. But my question is this for the PVO. You mentioned that the private sector debt is not being crowded out by the increased borrowing in the public sector debt. So I'm quite interested to know whether you've done any work on private sector debt in particular, and what actually is that doing? So if you're saying that it isn't being impacted by the more borrowing by the public sector, then what is it actually doing? What is the status? If you have that information, I would be grateful. Thank you. Thanks, Chair.
Thank you, Honorable Judge. Okay, can I continue? Thank you.
Yeah, I also had my hand up.
Honorable Lewis.
Thank you very much. I don't have great Wi-Fi signal here, but Chair, it's so great to hear that so many members of the committee share the very serious concern around the bailout of SAA, and point was made by the presenters as well. It's great that seems to be a common position on this matter. Very refreshing, and of course it is a bailout, regardless of what the minister says. It's obviously a bailout. So I just want to remind, this is a comment more than a question, I want to remind members of this committee that this is not just an oversight committee. It has legislative powers, and the budget is a bill. It's a piece of draft legislation, and we have the power to amend it. So if we are all so concerned and about this bailout and object to it so strongly as we all do, then we have the power to stop it. And I would encourage all of us to use that power. It would be unprecedented, and it would send a great message that public money should be used for the poor, for the benefit of the poor first and foremost, and that essential public services should be protected from use for these wasteful bailouts. And if any one of the members in this committee who have raised these concerns today proposes that amendment, I promise you I will support it. Thank you.
Thank you, honorable members. Can I then continue? Honorable Masango, are you back? Okay, Honorable Masango, please mute then. Please mute then.
I'm trying to connect.
Yes, okay, try. Let's see whether we can get you. Honorable Masango. I can see Honorable Masango is really struggling with connectivity. I will jump here.
Honorable Chair, I'm sorry about the in and out. It's due to.
I will jump here.
Honorable Chair, I'm sorry about the in and out. It's due to the poor connectivity. My apologies to the committee. I just want to come to the issue of the SAA, and from what I heard from the other members is that as finance committees, we have all the right to call SAA to come and explain. And I think over and above that, Treasury needs to come to the party for the breakdown, because we want to understand if this is not a bailout, whether it's a bailout or not, what is this money going to do? What is it for? So that when we do our oversight, we can be able to see that that money is used for what is meant for. And I share with the members on the issue of the decision of cutting on the municipalities. We are just fresh from last week from local government, a provincial week. I'm still depressed with the situation that we saw. I'm not yet recovered. So if we are going to add to the burden, what do you expect from those municipalities? What do you really expect them to do? I don't know. Chairperson, my last point, the issue of the wage bill, I agree with what Honorable Kaiso is saying, that the wage bill should be taken to, or should be left with the relevant structures, the PSCBC, to deal with it. But as a committee, I think we have the sentiments that we have raised that we don't allow, we don't agree with what is happening, but it will be resolved at that level. And the relevant structures has made pronouncement. We are saying we have essential workers who have kept the country safe, who have kept the country run. But at the same time, we want to punish them. We don't want to, we seem not to be wanting to show gratitude at the work that they are doing and appreciation at the work that they're doing. That's my interpretation, Chair. Thank you.
Thank you so much, honorable members. PPO, as you come in, and FFC, especially as it relates to SAA, please also reflect on the implications of the debt guarantee that government give to the specifically to SAA, if that's not honored, rather the implications, okay, so that we get the full picture. Please continue, Dr. Janchis.
Thank you so much, Chairperson and honorable members, for the questions. I'll just quickly run through some of the points, and my colleagues will also jump in there. I think the first point I just want to highlight, to emphasize on, is the issue of the importance of consumption in our economy. It's a very important part of the economy. So any suppression or any depression in consumption will certainly affect our economy. So it's very important to realize that, to emphasize that point. The point around the tax, 5 billion, which now was noted by Honorable Josephs. I think there hasn't been specific mention by government what taxes would that be, but I think the National Treasury did mention that there aren't any plans to impose new taxes on the economy. But I think one target that they are looking at is the issue around fiscal, limiting the inflation adjustment of the tax brackets, which will result in some tax revenue being realized in that regard. The issue around zero-based budgeting, I think in our presentation, we in August, Chairperson and Honorables will remember that I think what we've said there is that we have acknowledged that there are areas of potential efficiencies in public expenditures which needs to be explored, and where some of those wastages need to be dealt with in a more strategic, systematic way. And I think what we have mentioned, or what we have shown in particular in a presentation, Chairperson, is that we're trying to show that based on experiences of other countries or other entities which have implemented zero-based budgeting, there are pros and cons, which in a way start questioning what's the main objective of trying to implement the mechanisms. Are there any other better mechanisms, or better way? I mean, rather than oversimplifying the problems in spending, there need to be clear indications. What is the really problem statement trying to address in this regard? So it's not a negative outlook. It's just to emphasize the importance of the pros and cons, and what are the risks and challenges and objectives for realizing those risks. The issue around the COE, compensation of employees, I think what we're trying to emphasize here, Chairperson and members, is the issue of the implications. When you look at the bulk of it, obviously, as we're saying, it focuses on the service delivery areas and so on. So, the question we ask is, what would be the implication for service delivery in that consideration, and also the implication for economy? I mean, we mentioned the issue of tax, as a stable, commission employees as one of the tax base stabilizing the PIT in that regard. So that's the sense that we're trying to look into what service delivery implications and what other implications, and how do you deal with that or take that into account when you implement the provisions of that. The last point I've mentioned before I give my colleagues, the issue around fiscal primary supplies. I think what we've shown in the presentation, it's our experience over the years, what has been the outcomes of the targets in terms of realizing the fiscal objectives. And I think what we're trying to emphasize that we've not been able to attain our targets quite convincingly, or we have not been able to attain our targets in realizing some of these fiscal objectives. And that means that we have to do something different or more, different things in order to realize fiscal objectives going forward. The revenue certainly has to grow, economy has to grow, there must be more. Cutting expenditure also might not necessarily be enough in this regard. Thank you, Chairperson. I'll give Dr. Mohammed to start as well.
Thank you, Dumisani. Thank you, Chair. I'm going to start with the first question by Honorable Shabambu and about austerity. And there are different ways of defining austerity. The one way that I prefer is to look at rates of unemployment in the economy. And so, I mean, in South Africa, we've had a history of mass unemployment, but we've seen over a period with fiscal consolidation that that it has had a negative impact on economic growth, and it's had a negative impact, therefore, on debt to GDP levels, but also on unemployment. And that you could, from that kind of argument, argue that we had austerity type budgeting, but also in particularly now in dealing with the crisis and the sharp cuts envisaged, I think we can speak about austerity. The second question was by Honorable Dutoy on inflation and when do we expect inflation to increase. And to understand that inflation happens when you don't have when there's a pressure on prices in an economy because of supply, and it's supply declines of certain goods, and there's too much demand for it, then you have inflation. It can also be imported inflation, where the price of the goods you import, like oil, for instance, go up. But that can be affected by the exchange rate. So if the rand suddenly weakens a lot, we're paying more for imported goods, and that can affect inflation upwards, especially if it's things like oil and things we need. What's happening globally, and we're seeing it in South Africa as well, is that with the crisis from COVID, the economic shutdowns and now new shutdowns, global demand is very low, and so there's an oversupply in many areas. And we see, for instance, the oil price recently, in response to the shutdowns, has come down. And I don't think people are envisaging in the medium term, at least, that they're going to be, and I'm talking about projections by not only National Treasury, but the IMF, the World Bank, the UN organizations. I don't think they're envisaging inflation to increase substantially. I mean, there could be certain specific goods where the pandemic could affect employment in healthcare, and that things we supply could decline. But overall, as an aggregate, we can't. The CPI isn't envisaged to increase in the medium term and even over longer period. I want to talk about zero-based budgeting. I think Dumisani covered that. Just to come to the question of that Honorable Peters raised on state-owned companies and keeping them supported and bailing them out because of employment, I think we should see them as playing a much larger role in the economy than that, especially SOCs like Eskom, those that provide water and essential goods. So that does raise questions about SAA and more money for SAA. But we require electricity and electricity to function well. So we need to fix them up, and we need to help them when they get into debt problems. And I think we need to recognize that, as we said in earlier presentations about Eskom, that these are long-standing problems, not only related to state capture and corruption, but the overall management of Eskom through the 80s right through to now. And so we're sitting with a problem that wasn't adequately dealt with over the last 20, 25 years. And we to some extent, we're paying for that now. And so, and also related to the increasing cost of the new build for Eskom. Honorable Sarapin, I'm just going to rush quickly. I don't think there's a disagreement between PBO and FFC on the wage bill. I think we agree the FFC is saying that what's happened is undermining the bargaining council and could cause problems. We're saying something, and we raise, I think, in our conclusion as a question. But overall, it's about questioning the credibility of the numbers that have been in the MTBPS. And in terms of the public sector wage bill and aggregate demand, as you said, I mean, the public sector workers are about 20%, but as we say now in our presentation, that public sectors have formal, permanent, relatively good jobs compared to other people, and during times of crisis, they still get paid. So they play the role also of a fiscal cushion in a sense, when other sectors cut, especially informal sectors and other sectors with precarious labor, cut numbers. The jobs in the public sector are more secure. And so we do see an impact on aggregate demand linked to cutting public sector wages. On the question by Honorable George on private sector debt, I mean, what we are seeing, and we've seen this not only in South Africa, but many other countries, is that corporations, especially the large ones, have taken on huge amounts of corporate debt. In South Africa, I showed that from 2015 to 19, or was it 2013 to 19, 7.6% of GDP levels increasing debt by the private sector, but at the same time, declining investment. And a lot of that money could be going into ongoing operating costs and dealing with inefficiencies and other things in private sector businesses. But we also have seen in South Africa and globally more of that money going to financial transactions and activities in financial markets for non-financial corporations, especially to increase their incomes and their profits, and things like share buybacks, etc. And so you're seeing high bonuses and high payouts for executives and stuff, even while profitability and investments declining by the private sector. So there's a lot of literature on this internationally. There's a smaller literature on this in South Africa, and I think some of that might be worth exploring. I think I'll stop there and give my other colleagues, Nelia, Olande, and other colleagues a chance to respond as well. Thank you, Chair.
Thank you, Siraj. I will just start with members. We are really happy that at this stage, the Treasury is actually acknowledging that they need to implement program performance budgeting system, that it's now necessary, because they really acknowledge that they need these evaluations and program reviews that they didn't include in their budget decisions. In terms of, there was a question in terms of the performance data that also links to this, that the performance information is now settled in the DPME. And they've been doing reviews for quite a while, but it really takes a long time to come to a conclusion in terms of the reviews that they do. So it doesn't really feature into the budget process. Something else that we also wanted to carry over in our presentation is that most of our policies, including the district model, basically indicates that there's still a lot of other things that need to happen before the district model can be implemented. The model is actually indicating that political power struggles that have characterized local government in South Africa in the last decade is a blockage. Poor public and stakeholder engagement is a blockage for implementing this model. So there are quite a few of those that has been identified as blockages. The same with the NHI. There's still a lot of things that need to happen before the NHI can be implemented. We actually also, even in terms of this budget, there's a long list of things that has been indicated that needs to happen for this budget or the medium term to be implemented. So we are talking about the COE and the reductions in the COE. This actually has been mentioned by the minister in the budget already, and the minister was basically pressured to implement those reductions. And some of the other things that's outstanding that will also have an influence on the COE which are listed in the MTBPS, is the number and the size of departments, ministries and public entities in national and provincial governments. So those are discussions that still need to happen that will inform the medium term. It will influence the COE and it will influence all the other budgets going forward. They also indicate that they need to contain the public service wage bill, but they must still have negotiations. So it's almost like all of these, as Mr. Sachs also indicated, we shouldn't actually look over the medium term. It's basically what's going to happen next year, because we can see the decreases in next year that might cause problems for service delivery. Then there was also a question about where the money is going. The only indication that we currently get is in the appropriations bill for SAA. The 6.4 billion is basically going for the settlement of the government guaranteed debt, and the 10.5 is appropriated for the implementation of the business rescue plan. Then in terms of Honourable Peters, your concern about the NHI, there's still a lot of things that needs to be happened with the NHI, but even in this budget, in the appropriations bill, there's a lot of reductions in terms of the expenditure on the NHI. They're actually reducing the NHI grant with 70 million. They're also reducing the health facility grant in terms of the NHI with 216 million in the current appropriations. And perhaps we can talk about this in our next presentation next week, but there are no ways that we will implement the NHI in the time frame that they've allocated if we keep on reducing the budget or not spending the budget and making adjustments. Yes, there was a question about the procurement bill, and we did do a presentation. I think Dumisani also indicated the procurement bill does provide for localization, but those discussions are also still continuing, and we haven't seen the updated draft of the procurement bill, which still need to be discussed or tabled in Parliament. Thank you. I'm not sure if any of my other, I think Rashad will also need to respond to his slides.
Okay, thank you. I had two questions that related to my work. The first was regarding fiscal slippage, and this was by the question by Honourable Du Toit, as well as related to a question by the chairperson. So fiscal slippage is a function of several factors. Key among these is economic growth, revenue collection, as well as expenditure management. When the economy underperforms relative to the forecast, you have slippage. So your question specifically on factors that contribute to this is essentially any factor that harms economic growth, and that will contribute to slippage. So energy shortages, as you mentioned, the poor financial state of municipalities, which may require fiscal assistance, the growth of municipalities, which then affects the growth of the country and revenue raise in the economy, so municipal services and the way municipalities are managed, as well as anything that may affect investment decisions in the country, the investment climate. So anything of that sort will affect fiscal slippage. Related to that is revenue raise. So this is one, the function of economic growth, two, the realism of revenue forecasts, and lastly, the efficiency of the revenue collection agency, and that's been an issue over the past 7 years or so. And lastly is expenditure control. So if you have an expenditure ceiling, South Africa has an expenditure ceiling, it's quite credible with the exception of pressures emanating from SOEs. So if you don't plan to bail out a specific SOE and you keep to your ceiling, but then all of a sudden you have to bail out an SOE, then you have fiscal slippage. And that certainly has been a contributing factor in recent years. The other question was from Honourable Peters with regards to the juxtaposition between debt service costs and COE. I think it's important to note that debt service costs are a direct charge against the NRF. What this essentially means is it's not discretionary, it's not an appropriated allocation. So it has to come off a bit like a debit order you sign for your bank. So it comes off automatically. Every month you pay debt service costs to bondholders, whereas COE, along with goods and services and other forms of expenditure, is something that's appropriated. And so there's a different treatment of the two. The degree to which the country can afford it is obviously, the central question over here in terms of public finances. And I think over there, it's important to take not take an atomistic approach, but take a general approach, looking at the full picture, because any decision has implications in one way or the other. And time doesn't permit to go into that discussion, but I think it's suffice to say on that point. Thank you.
Right, before I
thank you, Chairperson, we are done.
Okay, thank you. But before I let in FFC, I asked you whether is it a good fiscal policy to budget for a primary balance in 5 years.
I think we'll have to respond to that maybe in writing, Chairperson. We'll take that and we'll respond that in writing, Chairperson.
But why? Okay, that's fine. Think about it.
Yes.
Think about PBO coming back. I'm saying under this, I definitely don't have an issue about reducing the public debt, right? I think it's obvious you don't want it to go too high. But to say by such and such you don't want to, I would like to hear you. That's fine. Can we allow FFC to come in?
Thank you, Honourable Chair. I'll try and answer one or two of the questions and then invite my colleagues to come in. I think on the question of austerity, first of all, I think the challenge with the word austerity is that it means different things to different people. And really, in a real sense, I think it's almost a political term. The question is that we need to face is what will be the impact of this medium-term budget policy statement on growth over the medium term and particularly next year. Because if the impact is negative, then as is suggested, you would have a situation where you cut expenditure, but growth falls by even more, and therefore you don't make progress towards that primary balance that you're trying to achieve. Now, we've been wrapped up in a lot of discussion about something called the multiplier. And I think it's important not to make these choices too abstract. Treasury has put forward an economic forecast, and you can see it on page 15 of the MTBPS, in which they show that government consumption next year is going to contract by 2.5%. And in their estimation, investment is also going to contract next year by, I can't remember, something like 1%. But Treasury is arguing in that forecast that there will be a rebound in household consumption, a significant rebound in household consumption, and a growth in net exports. And that those two forces between them will offset the contraction in government consumption. Now, underpinning their forecast is a bunch of assumptions, which are also listed there on page 15. Amongst the assumptions are that the commodity prices will increase and aggregate global demand will lift the South African economy. So the question is not whether austerity works or austerity doesn't work, in my view. The question is, next year, is that a realistic and plausible scenario? And what are the risks of alternative scenarios, which I think the Treasury does also point to in the annex of its of the MTBPS? And but certainly, a contraction in government expenditure is going to have a negative effect on aggregate demand. The question is whether household consumption expenditure will rebound sufficiently to offset that. The second point I wanted to make is that when it comes to these issues of the Reserve Bank, and I think, Honourable Chair, you're moving in that direction when you're asking, are there alternative sources of funding? I think the honest answer to these questions is that we don't know what the consequences of our actions will be in the current environment, because we are living in extraordinary times. Many emerging markets are engaged in quantitative easing. It's notable in the graphs that were shown by Dr. Mohammed that all of the emerging markets that are engaging in that level of bond purchase programs by their central banks, all of them have had falling government debt over the last 20 years. So if you look at a country like Indonesia or the Philippines or these others, they've had falling government debt. The only one that has had rising government debt is Chile. And if you look at the nature of Chile's quantitative easing program, they are not buying government bonds. They are buying private sector corporate bonds. So I think the answer is that A, we don't know what the outcome will be if we move in that direction. It could turn out okay, but it could also make our lives much more complicated by bringing in an element of financial instability. So currently we've got fiscal unsustainability. The idea is that if we have much more aggressive central bank interventions, we will kind of offset that problem. The question is, what is the risk of moving in that direction? And the risk is that you will move not towards inflation, but towards financial instability and a sudden collapse of the value of the rand. That is really the risk we face. And I think these are matters of debate, and we should debate them, but we should debate them knowing clearly that none of us really know this terrain or the nature of this terrain, and many different outcomes are possible. I would want to suggest that there's a central problem in this MTBPS that I think is highlighted on page 36 of the document. And the central problem, and the reason I'm raising it, is that I think it speaks to many of the questions that have been asked. That is on page 36. The document indicates that to ensure fiscal sustainability, there's a need for high-level policy discussion on a number of issues, including the funding of post-school education, the subsidy mix for urban transport systems, the structure of human settlements programs, the size of departments, ministries, public entities, national and provincial departments, the management of functions across 3 spheres of government, and some others. And what Treasury is flagging here, which is important, is that there is a need for policy decisions to back up the fiscal consolidation path that has been set out in the MTBPS. Let me put it in very simple terms. As I noted when I first gave my input, the Department of Defense will see a 9.3% contraction in its budget in nominal terms next year. So if it had 100 Rand this year, next year it's going to have 93 Rand. The question is there any policy decision that has been made to back up that fiscal choice? Have we decided to reduce the size of the defense force? Have we decided to withdraw from our ongoing deployments in countries like the DRC? Have we made some other policy choice about defense? And if the answer is no, that there is no policy choice that backs up that fiscal consolidation path, what is going to happen is likely that we're going to enfeeble the defense force by cutting its budget and not making a policy choice. And the same applies throughout all of the delivery of services. So the point that we're raising about education and healthcare is that if you don't decide what are the policies that give effect to your fiscal choices, the likelihood is you will impose the burden of adjustment on those least able to resist. And in the case of health and education, that is the recipients of those benefits. So public servants are well organized, they have unions, they may end up as is suggested by some, avoiding a 0% increase in their salaries. But then if the fiscal constraint is still imposed, it means even more of the burden of adjustment is being shifted onto those who are less able to prevent that burden applying to them. And that is the school children who depend on public services. So I would like to invite my colleague, Lawrence Erasmus, who's also an FFC commissioner, to add some input on zero-based budgeting and the issues of procurement that have been raised. And then I will ask Commissioner Mokadi, Aubrey Mokadi, to also add, after which we'll go to some of the researchers if there are any outstanding questions there. So over to you, Lawrence.
Thank you, Michael, Commissioner Sachs. Honourable Buthelezi, I wish to respond to one question of Honourable Joseph as to why the FFC is concerned about zero-based budgeting implementation. Now, certainly we don't have any dispute that zero-based budgeting leads to eradicating inefficiencies that perpetuates. However, this implementation has been tried before in the early 2000s, and it was abandoned due to it being time-consuming, it's complex, and also due to a lack of capacity and motivation at input level workers at their level to provide accurate information, which is absolutely essential for zero-based budgeting to work. So as a result, the FFC proposes that components of zero-based budgeting be institutionalized, such as mandatory periodic reviews of programs, and then also the strengthening of the process already initiated by the Department of Planning, Monitoring and Evaluation. As far as the procurement system is concerned, certainly it's no secret that we certainly need to have a look at it. We certainly need to boost our local economy, and structural reforms in that regard would certainly have to be prioritized. Thank you, that's from me.
I'm not sure if Commissioner Mokadi wants to come in. If not, I would hand over to Dr. Ncube, our head of research, to answer some of the other questions and distribute the answers to his team.
Thank you, Commissioner Sachs. I'll look at two questions and confine myself to local government issues. There was an issue which was raised by Honorable Shivambu on the growing debt to ESCOM and expressing his concerns about that particular debt and to water boards, and also the issue of the solution was top slicing the earliest to pay ESCOM and water boards. I think we share the same sentiments about the growing debt to ESCOM and water boards, and in future we may actually see also SARS coming into the picture, whereby municipalities are not remitting funds to SARS, so they will owe SARS some money. So it's something which is also looming in the radar. But as far as top slicing, the Commission will actually caution that particular argument. It can be done as a last resort, because top slicing can have some unintended consequences, especially on the most vulnerable. We need to know what is the source of the problem of this particular debt, why it is rising. Is it because of poor management, where consequence management has to kick in? Is it because of poor choices, which some managers take? Then if it is like that, top slicing may actually affect the poor who stand to benefit from the local government equitable share. So one has to caution that particular argument. It has to be looked at thoroughly, what is the cause of that and what measures have been taken, and top slicing is therefore a last resort measure to be taken. Then the other issue I want to respond to is the issue of district development model. The question was, what is it and what is it? What are we saying as FFC? And let me just take members of parliament back to our submission last year, whereby long before in 2019, when we did our submission on the division of revenue, which we worked on in 2018. One of the issues we raised in that particular submission is the city region development model, whereby the idea was to think, when we're thinking about development, we need to think regionally. We can exploit economies of scale if we think regionally, especially we move away from this silo kind of development. And we think where we can benefit from economies of scale. And when we look at the district development model, it's basically the same concept, whereby we are talking of these 44 district municipalities plus 8 metros, that when it comes to development, we need to think bigger and exploit economies of scale. And we see the development model, really, it may actually improve the coherence of governments in service delivery, terms of planning, terms of coordination. If you look at our submission, which I've mentioned, we really were concerned about lack of coordinated planning and lack of coordination, especially on infrastructure delivery and service delivery, and also lack of capacity. And you look at that model, it is meant to actually touch on those or address some of those elements. But looking at the MTBPS, our point was that that model needs to be adequately resourced for it to contribute to the development or the economic recovery program, especially in the municipalities. So there's a need for adequate resourcing and for clarity in the operational modalities of that particular model. That's what FFC is arguing in this particular submission. And thank you, Chair. I'll ask Eddie and Chen to respond to some of the issues there which have not been tackled by PPO or Commissioner Sachs and Commissioner Erasmus.
Thanks.
Ed, please, do you have anything to add? Or Chen?
Yes, apologies. Thank you very much, Honourable Chair members and Chair for Commission. So basically, I think there's just one thing that I would like to stress and also emphasize and respond to the Honourable Chair is that in terms of forecasting and that target, the fiscal target, credibility is of all keys because of all the importance, because that once you've lost, or once we've lost it, that credibility of forecasts, it really becomes it's no impact, not even if you say anymore or take on any policy position going forward. And as we've shown that over the years there have been this very strong sentiment of either of optimism that is and pushing the forecast into higher than what it should be, and so that kind of optimism will really cause our accuracy and also credibility, and basically the whole thing just becomes a bit of a useless exercise. And then in that vein, then the question is, I would urge the Commission, the Chair of this committee to really utilize the legislative tools and ask the questions around, for example, the impact, especially, for example, this localized product value chain, and the whole question around costing and pricing, It has been 20 years since the Fiscal Commission actually suggested the pricing and costing. And then back then already there was a discussion around data availability and so on. Let's remember that it's been 20 years since then. And if we still don't have the data systems and information for the past 20 years, then how come? And where have all that money gone to doing if we still don't have the information of output and impact? Thank you, Chair.
Thanks, Chair. I'll just respond to the one question from the Honorable Member Peters about how is the teacher assistance program going to be funded and whether it will affect the wage bill. Really, the point we would probably like to highlight there is that there is 100 billion rand that was announced by the minister as part of the employment initiative, but it's not very clear at this point in time whether that 100 billion is going to be earmarked specifically for certain position. I think the caution that would really perhaps members of parliament would like to exercise, especially in relation to some of this employment initiative, is that these initiatives which takes place outside of the public bargaining process, over time you find that the people who have been employed would then demand to be employed permanently within the public sector, as it has happened. We've seen it happen with the community health workers. And at times you find that there's variation in terms of salaries and by the different community health workers across all the provinces. So over time, inevitably, those employed would then need to be absorbed into the public health sector. That's when the public wage bill would then be affected. But at this point in time, we're not really sure how the 100 billion rand is whether it's going to be earmarked specifically for those positions or is going to be transferred to provinces as part of the equitable share or as part of the wage bill. But really, I think going forward is just to make sure that all these initiatives, when people demand to be employed to be absorbed into the public sector, it therefore does not impact on the wage bill going forward. It can have disastrous effect if not managed very well. Thank you very much. I think that was all.
Thanks, Chair. We're done from our side.
Excuse me, Chair. If I may have a minute to respond to the Reserve Bank question.
Yes, please.
I know you asked FFC, but I just wanted to say that, I think we as Mr. Sachs was saying, we have to be cautious and that we don't know what the impacts will be. But nobody's talking about, 10% of GDP size bailouts. I mean, we're talking about, at the moment, what the Reserve Bank is doing to stabilize financial markets is 0.5 or less than a percentage of GDP. The question is, can not only the Reserve Bank, but other state agencies that have money available and are involved in asset buying, can they increase say by 1% of GDP or 2% of GDP? So relatively small percentages given the situation and in this kind of emergency, and that will make a huge impact on reducing the risk and the payments on debt. When we talk about financial instability, I think we should be looking elsewhere. And I think the main issue, and it came up in the budget, and there was a special document put out on exchange control liberalization, and this is going to actually make derivatives trading easier and possibly fast in South Africa. And in slide 40, in our additional slides, we have something that we knew we wouldn't have time to present on financial deregulation and exchange control liberalization. And that is, I think, where we should be considering. It's the private flows, and this will come up before we discuss the budget next year. And I think we need to have a fairly in-depth and well-researched discussion of this. But my concern with the Reserve Bank possibly helping government by buying more bonds, whether it's for the financial stability reasons or to help with the debt costs, is much less of a concern for the financial health of the country and increasing of systemic risk. Thank you for the opportunity, Chair.
Okay, thank you so much. PBO, thank you so much. FFC. Obviously, economics is a social science. It's not a natural science. It's not a 1 + 1 is equal to 2 type of a thing. Many scenarios which may come out, but I think the importance of the interaction is that it opens a lot of avenues for all of us and areas that we need to consider as we try to deal with this challenge, which at the end of the day, I think we all agree that at the end of the day, the solution is in us getting proper economic growth to be able to deal with all other multiplier effects which emanate from a good economy, which is growing. Having said that, members, why don't we take a comfort break of about 5 minutes, and then thank PBO and the FFC, and for Mr. Sachs, I think we will also support the initiative that you are taking as far as Professor Blake is concerned. His impact. We did speak about it in one of our meetings, the first meetings that we had after his passing on, and we're definitely sending our condolences to the family and to the FFC and all of those people who interacted. To us, it was definitely a big loss. Yeah, let's just take a 5 minutes comfort break and come back to continue with the agenda. But thank you very much.
Thank you, Chairperson.
My stopwatch is ticking. I see some people are still here on the platform who are supposed to take a comfort break.
Chairperson, are you saying we should switch off?
Aye, Chairperson.
Welcome, welcome.
No, look, I'm a silent listener today. I'm listening carefully. I'm there.
I know
I'm there listening. I don't want to come out because of this network. So I'm inside. I'm here. I'm listening.
Honorable Chair, I just want to double check. I get the impression that you've invited us to exit the meeting, if I could put it like that. I wanted to know if that's correct, or you're expecting us to stay on after the break, as the FFC, that is.
The meeting is closed, isn't it?
Mr. Sachs, I think the chairperson excused the FFC and PBO from the meeting. He might be off on his comfort break right now himself, but the rest of the agenda is just for the committee. Thank you very much.